It's my privilege to introduce the speaker, Karthik Shastry. Karthik is a young and dynamic chartered accountant based in Bangalore, qualified in 2021 with professional expertise in direct taxation. He provides comprehensive tax services to a diverse clientele, including individuals, corporates, firms, charitable trusts, and multinational enterprises. He has begun his professional journey with Dhruva Advisors in 2021, where he gained extensive experience in corporate tax advisory, litigation support, and representation before appellate tribunals. Driven by entrepreneurial vision, he founded his firm R. Karthik & Co. in 2022, a firm specializing in tax compliance, litigation, and advisory services across various industries. Recognized for his keen interest and expertise in direct taxation, Karthik serves as a member of the Direct Tax Committee at Kannada State Chartered Accountants Association for years 24-25 and 25-26. He is a regular speaker at KSCA and ICA Bangalore forums and a visiting faculty in taxation at PES University, Bangalore. With this brief introduction, I hand over the session to the speaker, Karthik.
Namaskar. Good evening, one and all present here. I hope you had a very fruitful tax audit season. We have just completed almost, this season looked like a battle. Right? We fought till the end. Many battles were fought in the court as well this year. And rightfully, we were able to complete all the tax audits. Hopefully, we'll file all the corresponding returns as well as soon as possible and not wait till 10th of December. So, having filed all the returns, having filed all the audits, we have been doing everything. We have been filing returns, audit reports, certifications under the old Income Tax Act 1961. I think it is time for us to revamp the entire knowledge that we have as far as the Income Tax Act is concerned, and to also learn what are the new things that are coming up, and also to see what are the key changes that have been come up in the new Income Tax Act 2025. Of course, you might have heard saying that it's the same product in a different package. Just that the wordings have been changed, just that the positions have been changed, just that the way it is being depicted is changed. Maybe in a few places, instead of using words, they have used tables. Instead of using some rules, they have brought up with some schedules. So it's basically the same product in a same package. Although we say that it's the same product, we should not forget that there could be some changes. One could be intentional change, the other could be unintentional change that would lead to erroneous interpretations as well. So in order to understand the new Act comprehensively, I think we should thank the Bangalore branch for organizing this workshop. I think it is there for the whole month. So I think it's a very good opportunity for all of us professionals, especially after going through a rigorous audit season. It's time for us to understand the new Income Tax Act 2025. So the topic for today's discussion is pretty simple. It's one of the simplest provisions both under the old Act as well as the new Act. I am very sure that these were the chapters in our CA final exam as well, which was very easy for us to score marks. So that topic is set off and carry forward of losses as well as clubbing provisions under the Income Tax Act 2025, of course, but we will compare both these acts to see if there is any change in the wordings. Since we already know the 61 Act comprehensively, what we'll do is we'll do a quick revision of whatever provisions are there as far as these topics are concerned, and then we'll understand what are the different wordings that are used in the new Act so as to make adjustments to our knowledge. Okay? So, of course, the agenda for today's session will be to discuss both set off and carry forward of losses as well as clubbing provisions. So first we start with set off and carry forward of losses. It starts right from section 70 in the old Act and goes on till section 80. So all those sections, whichever is important, we have taken. There are few miscellaneous sections which are not very important. We'll just briefly touch upon it and not discuss in detail. Okay? Yes, so I've given a small list of sections comparing those sections under the old Act vis-a-vis the new Act. So you can see that it starts from section 70, which gives us the intra-head or inter-source set off of losses, which is given in section 108 of the new Act. Similarly, section 71, which gave us the inter-head set-off of losses, is provided in section 109 of the new act. So on and so forth are given a small table giving a brief comparison of the sections that were placed in the old act and the corresponding sections in the new act having the same provisions. So we can just go through them once. Section 71B gave us carry forward and set off of losses from the head house property. The corresponding provision is there in section 110. And 72, which gave us business losses, that corresponding section is there in section 71B is there in 110 and 72 is there in section 112. And what I have observed in the new act is there are a few sections which got merged into a single section. So suppose there is a section 78 and 79 where in the old act we had what is the provision for set off and carry forward of losses in case there is a change in constitution of a firm. And in 79 we had where there is a change in shareholding in a company. So these two sections are actually merged in the new act, and both sections are given in section 119 of the new act. So in this way they have actually tried to merge similar provisions to make sure the reading is plain and simple. So in order to achieve plain and simplicity of the law, they have maybe tried to merge similar sections and to give it in a single section under subsection 1 and subsection 2, so on and so forth. Okay, so we'll quickly start with discussing these sections. Intra-head set-off of losses. It is given in section 70 of the old act, and under the new act it is coming in section 108. Okay, what is the basic provision of intra-head set-off and inter-source set-off? Loss arising from any source under any head of income should first be adjusted against any other income under the same head of income. Before even going to inter-head set-off of losses, we should first see whether I have two different sources under the same head, and if one of the sources has profit and the other source has loss, I have to first offset it against each other. Only then I should go to inter-head set-off of losses. To give an example, simple example, I have two house properties. From one of the house properties I have income, the other house property is a loss. I have to first offset the loss inside the head house property in order to arrive at the net income from house property. That is the provision. So under this provision, all other heads of income are fine. So if I have one business, I can offset it against loss of another business. If I have a source where one house property is a loss, other house property is an income, I can offset. However, under the head capital gains, we have a special provision. So what is the special provision? Short-term capital losses, if you have from any sources, it can be offset against both long-term as well as short-term capital gains. However, on the other hand, if it is a long-term capital loss, then it can be offset only against a long-term capital gain. If I have a long-term capital loss, it cannot be adjusted against any short-term capital gain. My teacher used to tell it in a very good way to say that chick madke can be fit in both chick madke as well as dot madke, but dot madke cannot be fit in chick madke. So this is how we have been remembering this provision. So short-term loss can be offset against both long-term and short-term gains, but as far as long-term loss is concerned, it should be offset only against long-term capital gains. And almost everything is copy-pasted to the new act except for the word computation. The word computation was not there in the old act, but in the new act they have inserted the term computation. In the old act it said loss resulting from any source, but in the new act we have loss resulting from computation of income from any source. But as far as interpretation is concerned, introducing this particular word computation may not have too much of relevance. It's still the same meaning that is given. Okay? So intra-head set-off losses is completed. Now we will go to inter-head set-off. So after adjusting all the losses within a particular head of income, if we still have a net loss from a particular head of income, that loss can be adjusted against any other incomes from any other head of income. That is given in section 71 of the old act. Corresponding section is 109 of the new act. Under this, it's the same provision. There is no change in the new provision. Everything, whatever was there in the old law, has been replicated in the new provision. However, there are certain rules that we have to follow. What are those rules? Firstly, if I have any loss from business or profession, I can adjust it against any other profits or incomes except for salary income. This was given in section 71 2A of the old act. The same language is being carried to the new act as well. If I have a loss from PGBP, that loss cannot be offset against my salary income. I can offset it against any other head of income. Now here comes an interesting proposition. So we all know that business income includes depreciation. So depreciation is actually given in section 32. It doesn't form part of loss under section 72. So we also know that under section 32, as a provision under section 32 subsection 2, unabsorbed depreciation can be adjusted against any income, including salary is the question. So if I have a business loss and an unabsorbed depreciation, can I adjust both of it against salary? Obviously not possible. Can I adjust depreciation? Because for adjusting business loss, I have a restriction under section 71(2)(a). But can I adjust the unabsorbed depreciation is the question. So in my view, although section 32 gives a separate computation for unabsorbed depreciation, it still forms part of your PGBP. So since it still forms part of your PGBP, in my view, unabsorbed depreciation also cannot be adjusted against your salary income. It can be adjusted against any other incomes or profits. Okay. The next point that we have to remember is the maximum loss that can be adjusted from house property against any other income is 2 lakh rupees. So if I have a loss of say 5 lakh rupees from house property, the maximum amount that I can adjust against any other head of income is 2 lakh rupees. And secondly, that we have to remember that this offsetting house property loss with any other head of income is not given in new regime. So if you are opting for new tax regime under section 115 BAC, then you don't have the option of adjusting loss from house property against any other income. So this set off of HP loss against other heads of income is available only if you are opting out of the default tax regime. If you are continuing in the default tax regime, your house property loss will get lapsed. It cannot be adjusted against any other head of income. Of course, it will be carried forward to next year. In the next year, if you have any house property income, it can be offset against such income, but within the year, you cannot adjust it against any other head of income. That is the provision that we have to remember. Next, there are few things that we have to remember in this. Yes. Coming to losses from house property. So losses from house property was given in section 71B of the S12 Act. Under the new provision, it is coming under section 110. So loss from house property, first under 70 we have to see if we have loss from two different sources. Even after adjusting within the head and inter-head, if we still have any loss that is still to be carried forward, I can carry it forward for the subsequent assessment years. And the maximum period for which I can carry forward is 8 assessment years. So assessment year and previous year is replaced with the term tax year in the new Income Tax Act 2025. So under the old Act, I can carry forward for 8 assessment years, but under the new Act, I can say that it can be carried forward for 8 tax years. So brought forward losses. So the next point that we have to learn under income from losses from house property is that suppose I have a brought forward loss from house property. In the current year, I have both income from house property as well as PGBP income. What is the loss? What is the income against which I can adjust this particular losses? So the provision says if you have a brought forward house property losses, you can adjust it against any other income arising from a house property. It doesn't say that any other income under the head income from house property. To give you an example, suppose I have a business of letting out residential units and I also have a business of letting out commercial properties. Both are house property, but one of it is taxable under the head income from house property, the other one is taxable under the head income from PGBP. So the provision says brought forward losses from house property can be offset against income from house property. So does it mean that I still have an option of setting it off against PGBP income arising from a house property? That is the question.
No.
Yes or no?
No.
No. Any other answers? The provision doesn't say brought forward house property losses should be adjusted against income under the head house property. It just says can be adjusted against income arising from a house property. If I am in the business of letting out commercial properties, my income is taxable under PGBP. So can I offset this brought forward house property loss against my current year income of letting out commercial properties is the question.
So,
Yes.
first of all, one question is whether we have an option
Mhm.
to have the house property income as well as the PGBP income. Because generally, the idea will be that if you have, let's say, 5 or 6 houses, you cannot say that you are either in a residential rental option or business. You have either one, right?
Correct,
So
correct.
is there an option? No.
Yes, yes, there is an option.
There is an option.
Yes, yes. So if you are in the business of letting out residential properties, then it is taxable as house property.
Oh, because of residential.
Yes, yes, yes. If it is commercial unit, it is taxable as PGBP.
See, as per house property provisions, it says if you are the owner of the property, it doesn't differentiate between commercial property and residential property.
Correct.
As long as it is a real estate property, then it is, you are the owner, then it is taxable under house property. So, application coming that it is taxable.
I think there is a recent amendment, as far as I know, there is a recent amendment to say that if you in the business of letting out house property, which is a residential unit, that will be taxable as income from house property. There is a recent amendment to the law. So in my view, this is possible. I'll explain why when we come to PGBP. Under PGBP, we have case laws like Nandi Steel, etc., wherein they have allowed brought forward PGBP losses to be offset against current year capital gain arising out of such businesses. So taking view from similar judgments, I would say that brought forward house property loss can be adjusted against your current year PGBP income arising from letting out of house properties.
So the language is same even in 2025 Act.
Yes, yes, the language is carried forward. So coming to losses from PGBP, of course, 72 will give you only losses from normal business. It will not give you the provision for losses from speculation business, for which we have a separate section altogether. Corresponding section in the new Income Tax Act will be section 112 of the Income Tax Act 2025. So loss from PGBP other than speculation business. So if you have any losses from PGBP other than speculation business, after internet set off, if you still have any losses remaining, that can be carried forward to subsequent assessment years. And the maximum period allowed is again 8 assessment years in the old Act and 8 tax years in the corresponding new Act. Again, the same provision that we studied just now, brought forward business loss should be offset against income arising out of any business or profession. So taking the same example ahead, suppose I have a PGBP income in the current year and I also have a brought forward business losses from last year. And as a consequence of maybe selling a few assets in the block, I have a short-term capital gain under section 50 of the erstwhile Act. So although the taxability is getting shifted to the head capital gains, it is still income or profit arising out of my business or profession. So this view was taken by the Karnataka High Court in the case of Nandi Steel. Nandi Steel Limited versus ACIT, where it held that although this is taxable under a different head, which is capital gains, the language used in section 72 is brought forward business losses can be offset against any income arising from business or profession. It doesn't say any income under the head PGBP. So therefore, it was allowed, and taking similar view, I would say that house property losses also should be allowed for set off. And another similar judgment, suppose I am in a business of trading securities. So even though you are in the business of trading securities, dividend income, if any, arising out of your holdings will still be taxable as income from other sources and not be taxable as PGBP. So even in such cases, there is a judgment that says that brought forward business losses can be offset against such dividend income arising from your business. Although it is taxable under the head income from other sources, it should still be offset against your dividend income. So similar view was taken in Supreme Court judgment as well. Okay. Then there are few other points that I wanted to discuss. What happens in case of exempt incomes? Suppose I have loss from an exempt source. Can I have the luxury of adjusting it against profits of a taxable source? So this question was answered by the Madras High Court, and it said if income is exempt, then corresponding losses also should be exempt. So any loss arising from an exempt source cannot be adjusted against profits of a taxable source. That is one thing that you have to remember. Yes, then next point is, it doesn't matter the jurisdiction of earning your business income doesn't matter. Even if you have losses from business outside India, such losses can be offset against incomes that you are earning in India. Suppose you have two businesses, one in India and one outside India, and if you have losses from business outside India, that losses can be offset against your PGP income that you are earning in India. Yes, the next question is, question of set-off arises after income has been computed under each head of income. So this is as far as the inter-head set-off is concerned. So that is what we discussed in the initial stages. That first you have to completely calculate how much is the income or net loss under each head of income. Only then you can shift to section 71 and then calculate whether inter-head losses can be adjusted or not. So first you have to completely close each head of income, only then you can see if you can adjust the corresponding losses. The last point is, this is of course under capital gain, I just wanted to add it here. We all know that under 112A of the Erstwhile Act and 198 of the New Income Tax Act, any short-term, any long-term capital gains arising from transfer of equity shares is taxable at the rate of 12.5% beyond 1,25,000. Suppose I have a long-term capital gain of such nature which is amounting to 1,50,000 rupees, and I also have a short-term capital loss from any other sale of say 50,000 rupees. So there are two options. One is I will offset this 50,000 with 1.5 lakhs and the balance 1 lakh rupees will be remaining under 112A, for which there won't be any tax and there is no loss to be carried forward to the subsequent assessment year. The second option is, since I have the luxury of taking exemption up to 1,25,000, I will adjust only 25,000 short-term capital loss and take 1,25,000 exemption completely and carry forward this 25,000 to the subsequent assessment year. So which interpretation is the right interpretation of the question? So I would say the first one is right. You have to first offset it against your 1,50,000 long-term capital gains and then you have to calculate taxes, because this exemption is not given in any section of the capital gains chapter. This tax rate is given in section 112A directly to say on the excess amount beyond 1,25,000, tax will be chargeable at 12.5%. So this is not an exemption or a deduction given in the capital gains chapter, but this is available at the time when you calculate the tax payable. So therefore, you have to first adjust the losses and then on the remaining amount you have to see whether you have to pay any taxes or not. Right? Then coming to another important section, wherein losses that can be transferred to the resulting entities in case of amalgamation, demerger or reorganization. This is given in section 72A of the Erstwhile Act and corresponding section is 116 of the New Income Tax Act 2025. 99% of the content is replicated. Here and there the wordings have been interchanged, but all the interpretation remains the same. Accumulated losses and unabsorbed depreciation of amalgamating company shall be deemed to be the loss or allowance for the previous year in which the amalgamation was affected. So there is a discussion point I would like to discuss later, but for now let us understand the provision. It says whenever there is an amalgamation between two companies, let's say, and if the amalgamating company, which is the transferor company, has any losses that are not yet offset, or if there is any depreciation that is still unabsorbed. If so, then such losses and unabsorbed depreciation will be transferred to the amalgamated company and it will be deemed to be the loss of the year in which the amalgamation is affected. It should be deemed to be the loss of the year in which the amalgamation is affected. There is a slight interpretation issue here. I will discuss it in the next slide. Other provisions related to set off of losses and carry forward will still remain the same. So now I have one small point to discuss. Firstly, accumulated losses will only mean losses referred to in section 72 of the Erstwhile Act, which means only PGBP losses should be considered. Suppose the amalgamating company has unabsorbed house property losses that cannot be transferred, that will get lapsed. If it has any other maybe capital losses, that can again never be transferred. Only PGBP losses under 72 and unabsorbed depreciation will be transferred to the transferee company. That is the first point. And the second point, which is an important amendment that has come up last year, to say that what is the total number of years that you can calculate. I'll give you an example. Maybe in 2010, two companies got amalgamated. One had, the amalgamating company had a lot of losses, and the loss got transferred to the transferee company, amalgamated company. And as per the provisions, it will be deemed to be the loss of the year in which the amalgamation is affected. That means 2010 became the first year again. Again till 2018 the loss was there. In 2017, that company again got amalgamated with another company. The amalgamating company again had the same loss. It got transferred to another company, and now 2017 became the year of amalgamation. Again from there another 8 years. So in order to plug this loophole, a new provision was inserted in the Finance Act 2025, and the same provision is carried forward to the new Income Tax Act as well. So it says, whenever there is an amalgamation, the number of years for which you can carry forward should be calculated from the first time in which the loss was computed in the predecessor company. So in this example, the predecessor company, for the first time the loss was calculated in 2010. So from 2010 till 2018, those 8 years were the years in which you could have adjusted it against any other profits, post which it should not be available. Of course, this is a prospective effect, so it will be applicable with effect from assessment year 26-27. So for all the earlier amalgamations that have happened, there is a possibility that those companies have taken the advantage of this loophole. So the new provision says, if there is any amalgamation, then the number of years for which you can calculate the carry forward should be calculated from the first year in which the loss was computed in the predecessor company. There is another interesting interpretation that could be made here. Although for the number of years there is an amendment, they say that accumulated losses and depreciation shall be deemed to be for the previous year in which the amalgamation is affected. Suppose, taking a similar example, in 2020 I have incurred a house property loss, or maybe I will not say house property because it's not allowed, I would say it is a business loss. And in 2014 the company got amalgamated with another company. Now I have brought forward losses of business losses under section 72 of the earlier act. In the current year, in the amalgamated company, I have house property income. Will I have the option of adjusting that loss against my house property income? Because they say in 2024, the loss brought forward from the erstwhile company will be deemed to be the loss in the year in which amalgamation was effected. That means this whole loss that is brought forward will become loss of 2024, and they also say that other provisions of carry forward and set off shall apply accordingly. So can I apply section 71 again to offset this business loss against my house property income of the current year? Possible. Yes, in my view it is possible because there is no restriction in the law. They don't say it should be again adjusted against business income. As far as this provision is concerned, that loophole maybe is still not taken care of. Only the number of years they have made amendment, but this particular point will still remain the same. So this is again the same condition that we have for taking exemption and transfer. So similar conditions are carried over to adjustment of carried forward losses as well. So the amalgamating company should be engaged in the same business. The accumulated losses should have occurred and remain unabsorbed for 3 years or more. Continuously on the amalgamation, at least 3/4 of the book value of the asset should be paid, and the amalgamated company also should hold the 3/4 of the assets for the next 5 years. So all those conditions that are there in 47 of the old law, it is still carried forward to the same law as well, and in the set of provisions also the same conditions are taken. Unless you satisfy these conditions, any losses coming from the transferor company cannot be adjusted. And if you have already adjusted any of these losses and if you violate the provisions, then in the year of violation, such adjusted loss will be deemed to be income. So that is the provision. So in case of violation, set off of losses allowed earlier shall be deemed to be the income of the amalgamated company in the year of violation. Coming to demerger, amalgamation is done. So coming to demerger, and as I said, amalgamation was in a we had this problem of the loss will be deemed to be the loss of the year in which amalgamation was affected. So such problem is not there in demerger. In demerger provisions, they have not used those terms. And even if you observe in the amendment, they have just amendment the provisions for amalgamation as well as reorganization. They have not kept the term demerger because in the demerger provision, that loophole itself was not there. That's why they have not taken it over there. Where losses of demerged company directly relates to undertakings transferred to the resulting company, then the losses will be allowed for carry forward and set off in the resulting company. So in demerger, we know that there could be multiple types of demerger. So one such bucket is that where losses of demerged company directly relates to the undertakings transferred to the resulting company. So suppose I have a loss where that loss can be directly related to the undertakings that are transferred to the resulting company. So in such cases, those corresponding losses can be taken over by the resulting company. However, in cases where that cannot be identified, where such losses does not directly relate to undertakings transferred to resulting company, loss shall be apportioned in the ratio of assets transferred and retained. So in such cases, I have to see how much of the assets are retained by the demerged company and how much of the assets are transferred to the resulting company. In the same ratio, I have to allocate the losses. So whatever losses that are not transferred to resulting company will still remain in the demerged company and will be allowable for offset against the same company. So identically, it is completely transferred to the new act as well. There is no change in this. Last point is reorganization, wherein a firm is succeeded by a company and the proprietorship concern is succeeded by a company and a private or unlisted company is succeeded by an LLP. Similarly, we have all those transfer provisions where these transfers are not considered to be transfers. So in such cases, losses will be carried over to the new transferee entity as the case may be. If it is a company, then such amount will be transferred to the company, and if it is an LLP, then it will be transferred to the LLP. The second point over there is if it is not a succession under those sections, in any other case, accumulated losses of predecessor shall be deemed to be the loss of the successor in the previous year in which reorganization is affected. Suppose if a business is taken over by another person, in case of reorganization, then all such losses will be carried over to the transferee entity as well completely. And again, it will be deemed to be the loss of the year in which the organization is affected. And again, the same amendment which was applicable for amalgamation to say that for the total number of years for carry forward, you have to see the first year in which the loss was initially computed by the predecessor entity. So now coming to loss in speculation business. So we had section 72 where we discussed loss from PGBP other than speculation business. 73 and corresponding 113 will give us the provisions for set off of losses and carry forward of losses in case of speculation business. So loss from speculation business, it's a special provision where you cannot adjust these losses against any other incomes. You have to adjust this only against speculation business profits. Suppose you have two different streams of speculation incomes, one of it is a loss, one of it is a profit. You can offset the losses against the profits of the other speculation business. But if you have any other profits or any other income under any other head of income, that cannot be adjusted. These losses should only be adjusted against speculation business profits. On the other hand, if I have speculation business profit and a loss from normal business, there is no restriction over there. If I have speculation losses, I cannot adjust that losses against any other income apart from speculation business profit. But if I have speculation business profit, if I have any other losses, I can offset that loss against this speculation business profit. And whatever after loss remaining after set off will be carried forward to subsequent assessment years, and the total number of years for which you can carry forward is 4 assessment years and 4 tax years in the new act.
One question.
Carry forward speculation can loss also be adjusted with the business income in next year?
No, only against speculation business profit.
Suppose during the current year you can adjust from the business income against business loss against the NI speculation. Okay.
No, even in the current year as well as the brought forward losses should always be adjusted against speculation business profit. Coming to loss under the head capital gains, It was given in section 74, corresponding section is 111 of the New Income Tax Act. So whatever net loss that I have after intra-head adjustment should be carried forward to subsequent assessment years. Intra-head adjustment of capital gain is given in section 71 itself. And unlike other sections, intra-head adjustment of capital gain losses is given in section 71 itself, where it said that short-term capital loss can be adjusted against long-term as well as short-term capital gain. Long-term capital loss should be adjusted only against long-term capital gains. Any net capital loss remaining after such intra-head set-off can be carried forward to subsequent assessment years. And the maximum allowed period is 8 assessment years in case of old Act and 8 tax years in case of the new Act. And whatever losses that are brought forward from earlier year, we have to still follow the same principle. Suppose I have brought forward short-term capital loss. In the current year, I have the liberty to offset it against both LTCG as well as STCG. But brought forward long-term capital loss should again be adjusted only against long-term capital gain of the current assessment year. So it cannot be adjusted against short-term capital gain. So the same principle that we followed for adjustment within the head for the same assessment year, the same principle should be followed for the brought forward capital losses as well. So here, if you can observe, the word says losses under the head capital gain arising from transfer of short-term or long-term capital. That is why the courts have allowed in those other cases, because there it did not mention the term under the head BGBP or under the head income from house property. Losses from owning and maintaining racehorses. Surprisingly, even under the old Act as well as the new Act, under income from other sources we don't have the provision of carry forward. Intra-head set-off is possible. Suppose I have from one source I have income, from other sources I have income, other source I have loss. I can offset it against each other. But if I still have losses remaining within the head income from other sources, I don't have the option of carrying it forward to the next year, because there is no enabling provision both in the old Act as well as the new Act. The only provision where it allows for carry forward is losses from owning and maintaining race horses. So if you are in the activity of owning and maintaining race horses, that is taxable under income from other sources, if you have any losses, it can be offset only against similar income. So that means if you have loss from owning and maintaining race horses, it should be adjusted against profits from owning and maintaining race horses. And that loss after remaining after adjustment can be carried forward to subsequent assessment years, and maximum period allowed is 4 assessment years in this case. And of course the brought forward losses also should be adjusted against current year's income arising from owning and maintaining race horses. The only change that has happened in the new Act is the term used called specified activity. So instead of telling it as owning and maintaining race horses, they have just changed the term to be specified activity, and they have defined what is specified activity to say that it is activity of owning and maintaining race horses. But as far as interpretation is concerned, it's the same. So coming to another important point, loss in change in constitution of firm or succession. So assume a scenario where there is a partnership firm and there are 3 to 4 partners, and whenever there is a change in constitution of the firm, what is the provision for carry forward of losses that are related to that person who either retired or dead? So where there is a change in constitution of a firm, loss proportionate to the share of retired or deceased partner shall not be allowed for set off or carry forward. So whenever a partner is deceased or retired, then the loss pertaining to the share of that particular partner will not be allowed for set off or carry forward. Where there is a succession of any business or profession other than by inheritance, accumulated losses shall not be transferred to the successor. Any other cases where the entire business itself is transferred to another successor, all the losses will not be transferred to the transferring entity. The same provision is carried forward to the new Income Tax Act as well. The most important one in today's discussion is losses in cases of certain companies, which was given in section 79 of the erstwhile Act, and it is given in section 119 of the new Act. So it says, if a closely held company would mean any private company for simplicity's sake. It says any company in which public are not substantially interested. In short, we usually call it as closely held companies. So if a closely held company undergoes a change in shareholding, brought forward losses cannot be carried forward unless 51% of the voting power as on the last date of previous year is still held by the same persons on the last date of the year in which such loss was incurred. So what does it mean in the first place? Suppose there is a company and the company has incurred certain losses. Naturally, the company is allowed to carry forward those losses to subsequent assessment years by virtue of section 72 of the old act. Now, in the current year where I have profits, I have to see one thing. What is that one thing? I have to go to the last date of the current previous year and compare the shareholding of that date to the last date of the year in which the loss was incurred. And while comparing, I have to see that at least 51% of the voting power remains same. So 51% of the shareholders, or voting power to be precise, for simplicity we can say shareholders. So 51% of the shareholders who were there holding 51% voting power on the date, on the last date of the previous year in which loss was incurred, should still be the shareholders in the current year holding minimum 51% voting power. Suppose there is a change in the shareholding, or few shareholders have sold their shares, few shareholders have come in newly. You can account for any of those, but end of the day you should see whether 51% criteria is matching or not. If 51% criteria is not matching, then losses pertaining to that particular year cannot be offset against your income of the current year. That is the provision. There's an exception for startups. So startups registered under section 8, I would not say 80 IAC because it just refers to eligible startups. It need not be taking exemption under 80 IAC. You should just be registered as a startup under DPIIT. So in case of an eligible startup under section 8, it says referred to in 80 IAC. So if the definition of eligible startup is given in 80 IAC, but it would still go back to the recognition of startup. Doesn't say those who enjoy the exemption under 80 IAC. So for those companies, this restriction does not apply if all the original shareholders continue to hold their shares on the last date of the previous year. So the difference is that in this eligible startup, you have to go back and see how many shareholders were there when the loss was incurred. So if all those shareholders are there in the current year, then your loss can be offset against the profits of the current year. You need not see the 51% criteria. So those shareholders could be holding a mere 20% as well. It doesn't matter. As long as the original shareholders are still continuing to be shareholders in the current year, then such losses of that year can be offset against income of the current year. 99% of the content is copied to the new act. However, there is one small change. So in the old act it says previous year is still held by the same persons on the last date of the year in which loss was incurred. But in the new act, they have just mentioned it as same person. I am sure most of you would have read this, arguments or maybe write-ups that went on LinkedIn to say, many of them gave different interpretations. To summarize all those interpretations, I would say that the old act mentioned persons, the new act mentions only person. Would that mean that a single shareholder should be there holding minimum 51% share? Even if we take that interpretation, I don't think it is practically possible. Because I would say that this is a mere mistake, oversight, and the intention of the law would not be to say that single person should hold minimum 51%. What will happen if that is the case? So what happens if the law upholds that since it uses the term person, you have to see a single person whether they are holding minimum 51% voting share or not. What could be the possible scenarios? No individual shareholder holds 51% of more voting power. What happened? Interstate transfer of shares among shareholders who hold 51%. Suppose I had two shareholders having 40 and 40, 80% each. And in the current year, suppose one person has transferred 30% to the other partner, or maybe there is some interchange in such that no one person holds more than 51%, but both of them put together are holding 80%. So if there is an inter-transfer between the shareholding, but end of the day, if those two put together are holding 80% shares, I should still be eligible for adjustment. But if I take the strict interpretation of person, then such adjustment will not be possible. And the third one would be if there is a new investor coming in and there is a dilution in the shares, and if no person is having more than 151%, then that would become a problematic scenario. So that is why I would not subscribe to that view, although that could be the right interpretation given the usage of the word. But I wouldn't say that it could be the intent of the law, because that would actually hamper the entire intent of the section. So therefore I would not suggest to accept that particular view. Yes.
Override amalgamation also.
Sorry, sir.
This one.
This.
For example, 79 whatever. Year 1 I incur the loss. Year 2 I amalgamate. The OT percentage and other things etc. is allowed and it gets carried forward. Year 3 when I have the income. Okay. Then there is a change in the.
No, year 3 you have to see in the amalgamated company whether there is a change or not. Because in
When the loss was incurred, so you have to go back to the.
No. That is only for calculating for how many years you can carry forward. But other provisions are still the same. So it will be deemed to be the year in which you have amalgamated. So year 2 will be the date of amalgamation, and the new shareholders will be the shareholders, because it says on the last date of the previous year in which the loss is affected. So it will still be deemed to be the loss of the year in which amalgamation is affected. So from that year you have to see whether shareholding has changed or not. And also interestingly, both under the old act as well as the new act, they say that if there is any change in the shareholding, so suppose if there is no change in the shareholding in the year in which you have to offset, if there is a change in the previous year, whether this provision itself should be applied or not is another question. Because the starting word of both under the old act as well as new act, it says any change in the shareholding during the previous year. What if there is a change in the earlier year and now you have to offset it? Whether you have to apply 79 or not is a question. And then there was another interpretation taken by one of the courts where the 79 is applicable only for business losses. It is not applicable for unabsorbed depreciation. So if you have unabsorbed depreciation, you don't see whether you have 51% or not, you can still offset it against your income. Is the interpretation that is taken. So there are a lot of things that we can dig in this particular section. Lastly, whenever we are incurring losses, we have to tell the government that boss, we are incurring losses. So that telling happens in return of losses. So under old act it was given under section 80, in the new act it is given under section 121. The following losses shall not be allowed unless return is filed in accordance with section 139(3). So first is of course business loss, second is speculation business, third is specified business which is as per 35 AD of the old act, capital gain losses and losses under IPOS which is owning and maintaining race horses. So the losses that are not covered under this would be typically income from house property. If you have any loss from house property, even if you file your return after the due date is over, you will still be given an option to carry it forward, because there is no restriction under this particular section to file return of losses to carry forward that particular loss. Even if you file, of course you have to file the return, but it doesn't say that you have to file it within the due date in order to carry it forward to next year. And the second one would be unabsorbed depreciation. So both house property losses as well as unabsorbed depreciation, even if you file the return beyond the due date as per 139(1), typically if you file under 139(4) of the old act, your losses will still be eligible for carry forward. The same provision is being replicated in the new act as well. So under the new act there is no difference between subsection 1 and subsection 3. If you observe, they say that filed in accordance with 263(1). So 263 is corresponding to 139 of the old act. So under old act, first we go to 139(3) and then we go to 139(1). But under the new act, there is no such confusion. Directly we go to 263 subsection 1. So as long as you are filing the original return within the original due date under 263(1), you will be eligible to carry forward this particular losses. And again, this restriction is there only for carry forward of losses. Suppose you have inter-head adjustment, inter-head set-off of losses within the same assessment year or tax year, you can still do it even if you are filing your return after the original due date. So this return of losses to be filed within time is only for carry forward of losses for next year. The same year, inter-head losses can be adjusted even by filing a belated tax return. If you have any questions, we can discuss.
If there were losses in a particular year and the return was filed on time and carried forward, but in the subsequent year again, there was a loss, but they forgot to carry forward the loss from the previous year. So is it necessary to carry forward, like if you remove that third year?
No, strictly speaking, there's no provision like that. But of course, in the section, if you read the law very literally, it says first you have to bring forward the losses, and then if after adjusting, if it is not yet adjusted fully, then again you have to carry it forward. But I don't think that is the one that is followed. Even practically as well, suppose you file return for AY 23-24 with a loss, and 24-25 you forgot to carry forward that losses. 25-26, if you report the same loss of 23-24, CPC, in my knowledge, it is still allowing. There is no problem with that. As long as you have filed that year's return on time, it's fine.
This
I
act
think
is
the
only,
utility will automatically carry forward. So we
Yes,
don't
yes.
have
Now
to-
utilities we have, it
Even
will
the
automatically.
assessment orders, they automatically carry
Yes,
forward.
yes, yes.
There is no question of losing.
Correct. And in 3CD as well, now from last year we have a separate provision. For brought forward losses, we have to now mention the date of the order, which is the intimation order, as well as the DIN number of that particular order. They are asking for remarks also, and the remarks also have been made mandatory.
This IT Act 25 is only for new tax regime.
No, it's not for new tax regime. Both old regime as well as new regime is there.
It's overriding the earlier act.
Yes. It's just the old act will be repealed and the new provision will come in. But the new act also will have both old regime as well as new regime. Parallel. Yes.
So one more question.
Yes, madam.
This is more of a technical thing. You mentioned earlier that house property law, business laws, if we carry forward, we can, house property laws, if we carry forward, you can adjust it against any other income of incurring from,
House
arising out of
property.
house property.
Correct.
So whether the utility allows that provision, I feel it is
No,
not,
that is the
not
problem.
allowed. So
Utility
in
will
that
not
case,
allow.
Then how do we, this one, because we don't have any other choice how to claim
Maybe
that.
we may have to make an application for AO.
Okay.
And then we have to change. And same, whatever case I discussed, PGBP losses, the utility will not allow us to do it.
Yes, sir. And we have no other option because we have to use that utility.
Correct. And since you mentioned house property, I just remembered another scenario where that could be possible. Well, suppose I have a brought forward house property losses, and in the current year, I have a house property income chargeable under income from other sources. That is also possible. If I have taken a property on rent, and if I am subletting a portion of it, since I am not the owner, it is not be chargeable under house property, it will be chargeable under IFOS. So it is an income arising out of house property. Although it is chargeable under IFOS, I should still be, able to offset the brought forward house property losses. But utility, again, like you said, it's a practical issue. We'll move forward. The second part of the discussion, a very short and simple discussion, is on clubbing of income. Of course, the Act doesn't use the term clubbing. It says income of other persons included in the total income of the assessee. But for all practical purposes, we call it as clubbing of income. So the first and foremost section is section 60 vis-a-vis 96 of the new Act, which says if there is any transfer of income without transfer of asset to another person, then such income will be taxable in the hands of the transferor itself. You cannot, divert that income to be taxable in another person's head since you are the owner of the asset or you hold the rights of a particular asset. The income cannot be put to tax under the hands of another person. If so, then any of the such income will be brought back to tax in the hands of the original transferor. The same provision is carried over to the new Act as well. And here it uses the term person. So going forward in section 64 of the old Act, we get to see that the term used is individual. But in this section it says person. So person we have to draw back to 2 clause 31, which includes every kind of assessee. So under first section we learned that if you are transferring any income without transferring any asset, the income was brought back to tax in the hands of the transferor. The next point is, what if I transfer the asset itself for inadequate consideration? So where there is any revocable transfer means I have the right to claim the rights back to myself. So we will define what is revocable transfer. So where there is any revocable transfer of asset, any income arising from such asset will still be chargeable in the hands of the original transferor. Suppose I transfer a particular property in the name of another person, but under the a condition that will be revocable at a later stage. So in such cases, it will be treated as revocable transfer, and I will still hold the potential rights of that particular asset. So therefore, all the incomes, although the asset is legally transferred to another person, the incomes will still be chargeable under my head itself. So irrevocable transfer is merely an exception to revocable transfer. In the old act, we had 61 separately and 62 separately, but under the new act, inside 97 itself, 97.1 gives you the provision for this revocable transfer. 97.2 will give you where 97.1 is not applicable. So where are the cases? Which are the cases where 97.1 is not applicable? Where asset is transferred to any irrevocable trust. Of course, if it is a revocable transfer, income will be shifted. But if the asset is transferred to an irrevocable trust, then the income arising from such asset will not be taxed in the hands of the transferor. And if the asset is transferred on revocable basis to any other person, irrevocable basis to any other person also, then such income will not be taxable in the hands of the transferor. So this would technically mean that only if it is a revocable transfer, then any income arising from such asset will be chargeable in the hands of the transferor. If it is irrevocable, then the income will not be shifted back to the transferor. So while you are following this particular provision, you should also see a very small condition which was given in a proviso earlier. Now it is given in the subsection itself, that the transferor does not derive any direct or indirect benefit from such income. So even if it is an irrevocable transfer, suppose there are cases where directly or indirectly you are still deriving some benefit from such asset or income, in such cases income will again be taxable in the hands of the transferor. So that's like a condition. If you are deriving any benefit, then this exception will not be applicable and I have to go back to 97.1. So they have defined what is transfer deemed to be revocable, where it contains any provision for retransfer directly or indirectly of the whole or any part of the asset or income to the transferor. It in any way gives the transferor a right to reassume the power directly or indirectly over a whole or part of the income or assets. So if I have any clause or a proviso in the agreement maybe or in the the conditions that I will reclaim the right to use this property, then it will become revocable transfer and all the incomes will again be taxable in my hands. Coming to section 64, the new provision is section 99, wherein income of a spouse or a minor child is added to the income of the spouse or the parent. So income of spouse of an individual by way of salary, commission, fee or other forms of remuneration, cash or kind, from a concern in which such individual has substantial interest. What does it mean? Suppose I have a particular entity in which I have invested, or maybe I hold shares, or if there is a partnership firm, I have some equity capital or whatever in that particular firm. And if there is any income arising from that particular entity to my spouse in the form of maybe salary, commission or other forms of remuneration, it will not be chargeable in the hands of my spouse, it will be taxable in my own hands. So it means to say that income of spouse of an individual, here you can see that they have used the term individual. So in the earlier section they have used the term person. So income of spouse of an individual by way of salary, remuneration, commission or any other form, whether in cash or kind, arising from an entity in which I have substantial interest. So this doesn't say that the spouse has substantial interest. The individual to whom the clubbing provisions are proposed to be applied, that individual should hold substantial interest in that particular entity. In this substantial interest, there is a small change. Substantial interest in the old act, we had if it is a company more than or equal to 25% of the voting power, and if it is any other entity other than company, it was 25% or more of the capital or profit sharing in that particular entity. But while we have in the new act, which is IT Act 2025, this 25% is changed to 20%. So under the new provision, if it is a company, if you have more than or equal to 20% of the voting power, and if it is anything other than company, more than or equal to 20% of the capital or profit sharing. So this is the change that has happened from the old act vis-a-vis the new act. So if I have any interest of more than or equal to 20% in an entity, and if that entity pays any salary to the spouse, then such salary will not be taxable in the hands of spouse, it will be taxable in the hands of myself.
If both are having 20%,
Sorry?
if both are having 20%,
If both are having 20%. As far as that is concerned, this is the
so
law.
in each end you will
But if you see substance over form, then maybe you should not club it. Because both of you have similar interests, then it's not possible.
So in that scenario, every individual will be charged.
Yes. That is again subject to review. I don't have ready answer for that.
See, even 25%, now 20% is also very low. He
Yes.
might be holding 20%, but may not be a director of the company, so he has no say.
Correct.
Still it will be club.
Yes. Under the old act, I think we have a tribunal judgment to say that controlling as a director or otherwise is not necessary as long as you are holding voting power. So if you have voting power, clubbing provisions will be applied. So it doesn't matter whether you are having any decision making authority in the company or not. You may not be director of the company. If you don't have directorship in the company, you technically don't have any powers to have all the administration done.
But mostly the way they are structured is, husband and wife both are directors.
Mhm.
They have 50%, and both are paid remuneration, paid salary. So who will get clubbed in who's?
As a plain reading, they say that individual referred to in this section is the one who has greater total income. So if I have husband and wife, the clubbing provision should be applied always in the hands of that individual who has greater total income than the other.
It means all the other income also.
No, not the other income, only the incomes arising from this entity in which they have substantial interest, not any other income.
That is only salary.
Yes, salary, remuneration, commission, anything.
But if they both are getting equal,
Then technically there should not be any clubbing.
see, first of all, both are directors, both are holding 50%, right? And one is the spouse of the other. So, and technically, they both are appointed
Correct.
as-
Both are holding and both are having directorship. In my view, clubbing should not be applicable, but of course, I'll have to recheck on that before confirming. This is a very practical issue where a lot of private companies are there, where husband and wife are directors. That could be possible.
And they only did this for spouse, but they have excluded children for some reason. Children who are old age of 18 and
Yes. For children, only if other incomes are there, then it will be. Only for minor child, there is clubbing provision. For major child, there is no clubbing provision. Only for spouse, there is clubbing provision. So if you have a major child who is drawing salary from a firm in which you have interest, then such income will not be charged. The second point is income arising from transfer of asset to spouse for otherwise than by adequate consideration or agreement to leave apart. Suppose I transfer some asset to spouse without having any adequate consideration. If there is adequate consideration, then there is no problem. If there is inadequate consideration and any income is arising out of such transferred asset, all such income will be transferred back to the transferor. The individual who has transferred the asset will have to pay taxes. Of course, they say that if it is inadequate consideration, otherwise than by adequate consideration or agreement to leave apart. So if the husband and wife are having an agreement to leave apart, then in such agreement, if the asset is transferred to the spouse, then any income arising from such asset will be still taxable in the transferee spouse itself. It will not be transferred to the original individual. The same provisions are replicated in the new act as well. And whatever provisions are applicable to spouse, where the transfer of asset for inadequate consideration is there, the similar provision is there for transfer to son's wife as well, in the old act as well as the new act. Income arising from transfer of asset to any person or AOP, this is not for spouse. This is not transferred to any other person, not to spouse. This is the case where the asset is not transferred to spouse, but the spouse is deriving some benefit from that transfer. Suppose I transfer an asset to any other person, any third party or an association of persons. However, such third party is giving some benefit to spouse or son's wife. Even in such cases, it will be deemed that you are indirectly transferring this asset to your spouse or son's wife. Therefore, all the incomes arising from such asset will again be transferred in the hands of original individual. We have defined what is substantial interest. Now coming to minor child. So it is again given in section 64 1A to be precise in the old act. It is there in section 99 of the new act. So income of a minor child other than child suffering from disability referred to in section 80U. So if there is a child who is suffering from any disability which is listed in section 80U, then income of such minor child will not be clubbed in the hands of the parent. Such child will be assessed separately. So any minor child other than this child who is disabled, if the child has any income, then such income will be clubbed in the hands of that parent who has greater total income in the first year of clubbing. So whenever the income is arising to this minor child for the first time, in that year you have to see which parent has the greater total income. So only to that parent's hands you have to club this minor child's income, and for all subsequent assessment years you have to club in the same parent. You should not change the parent unless you make an application to AO proving otherwise and the AO allows you to do so. Right? And this particular provision is not applicable where such income is derived by the minor child by way of any manual work done by the child or activity involving application of skill, talent or specialized knowledge or expertise of that particular child. So I just observed while reading today, there is a slight change in this particular wording. In the old act it says, all income of a minor child other than disabled child will be clubbed in the hands of the parent. The exception was if the minor child does any manual work or the income is arrived by doing any activity involving skill, talent or specialized knowledge. But when we come to the new act, the manual word is missing. It says income by way of work done by the child. I am not sure how this would impact the interpretation because one provision says manual work. If it is any work other than manual, it should obviously be through any skill set or intelligence or any expertise. But we don't know. There could be a scenario where it is a work other than manual work, other than skill set or knowledge. If there is any such other work, then there are chances that such income will not be clubbed in the hands of the parent. It will still be taxable in the hands of minor child itself. Possible interpretation because of removing the word manual, but not sure how far this can go. Member of HUF. So if you are a member of an HUF where there is a transfer of separate property, the wording that is there in the old act versus the new act is in the old act they say it's a separate property. In the new act it says owned property. It would technically mean it is a acquired property. Where there is a transfer of separate property of a member of HUF for inadequate consideration, any income from such property shall be chargeable in the hands of the member and not the HUF. So suppose you have a acquired property from your own income. Such income should always be taxable in your own hands. You cannot transfer that asset to the HUF and make it to the pool of the assets of HUF. Only inherited property that you have got from the HUF should be taxable in the hands of HUF. If the member of the HUF has acquired any asset separately, such income from that asset should always be taxable in the hands of the member and not of the HUF. You cannot club it to the pool of the HUF because it is your own self-acquired property. It should be taxed separately.
So here, what is the definition of property? Like even if the money is transferred by a member to HUF and HUF invests that in stocks, for example, if there is a gain from the stocks, is that clubbed in the transfer?
Yes, technically yes, it should be taxable. That's why usually we don't suggest simply transferring everything to HUF.
But I think in 1961 Act at least property has been defined to include like any movable or immovable property.
Yes.
But the money, will you treat that as an
Yes,
movable?
I would still treat it as property. Because technically you are doing it to just shift the income base. So it should again come back to the original member itself.
Intent.
Yes.
If it is given as a loan,
If it is given as a loan, then there is no issue. Then it will still appear as loan in the hands of the HUF. It will always be repayable to the member.
and the income will go to the HUF.
HUF auditors.
So transferring and say it as a loan. If you are transferring, say it as a loan.
Accommodation.
That's to be repaid. No?
That is not the criteria asked for. I am not transferred. I
But
give
how
it as
long
a
you
loan.
will keep the loan in the books?
Who is going to ask you? It is a discretion of you. It is not a discretion of department.
But okay, so your point is valid, and it's a good point. But only point I am trying to understand, because nowadays everyone wants to create an HUF so that
Correct.
their properties they can say this thing. So they actually literally fight with us that why all the CAs are allowing to create an HUF, why you are not allowing. I said that no, it has to be inherited.
Correct. Correct.
So that's where. So
Only
are
if the
you saying
property is
that?
coming from that, you have to
So
send.
now if this loan thing, I think there will be queue of 500 people, right? Because everyone wants to get to the loan because people want to save the taxes. So, but is that acceptable?
Yes, sir.
It is a good thing. It is a good thing, but
It should be
go for
acceptable.
litigation.
Could be subject to litigation as well because the intent matters again.
You dispute as per the law.
It's a good point, but I'm just thinking that whether it will get into litigation, because a lot of people would want to.
If you are strong in your law, well, let it go.
The loan should carry interest.
I can give it
Can
free
be
of
interest
cost.
free.
So where it says it should be given with interest. Okay, I'll charge 1 rupee. Forget it.
Sir, if you don't give interest again in the hands of HUF, it could trigger 48.
Exactly.
Yeah.
Because if you had taken loan from anybody outside, then you were supposed to pay interest. Since you are taking it from a member, you are not paying.
As a nominal interest, you got to get a.
Money received as a gift.
Now, then you are under this.
Yes. Inadequate consideration is that only.
That you are fairly asking.
But like from HUF is written, and the mother or the father gives as a gift money.
To the HUF.
Yes.
So throwing it to
No,
a common
if-
act.
Then it becomes
It is again inherited only.
Yes.
Then it is not taxable.
Sir, inherited means a different meaning, no? After the lifetime, no? There is inherited. Because it says giving. Inheritance is a difference.
Correct.
Okay.
Inheritance
Gift is a
is
different.
after the lifetime. During the lifetime of the transfer, you cannot call it as inheritance.
Then maybe in that case interpretation would differ.
The gifts as a money.
Then you are liable to pay tax.
So you are saying since the mother and father are still alive, it cannot be technically called
Ah,
inheritance.
you cannot call
Yes,
inheritance.
it is a gift. I mean, that is not.
That gift is taxable in the hands of mother or father.
Oh,
But
yes.
In the hands of,
but the income arrived out of that.
correct, will be
money-
taxable in the hands of mother and father, correct.
Yes. But the income arise out of that gift is taxable in the hands of HUF.
No, no, no.
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 The income arising from transfer of that gift only will be,
It will also be
yes, brought back to the
taxable
transfer.
in the hands of
Correct.
parents.
Suppose you take money and invest in shares, whatever income you get from that shares will be brought back to the transfer.
Also, 56 rupees also left. Right? Gift in excess of 50,000. No, if they are not members of HUF, then receiver has to pay tax under 56 too.
Because HUF is not
In
related.
that case, there is an exemption coming in. To the ancestral like that.
No,
fathers.
for
Father will
HUF,
come
HUF it
related.
is only members.
Oh, correct.
For HUF,
So
it is only
HUF
members.
will not become related. Only members among themselves will become
Yeah,
related.
HUF is not. Best way is keep it as a loan and pay. Because it is a pure discretion, person who is giving it and person who is. As I said, we charge a nominal interest and go down.
Yes, I think we have come to the end of the session. We can discuss any more points if there are any. Yes, we can conclude.
Sir, you mentioned there the important points while discussing.
Yes, sir.
70,
Okay.
you were discussing.
Yes.
So those important points, by way of judgment of this Nandi tree and now, what is has done illumination be cultured in New Act?
Yes, sir. All the interpretation will still be carried over to the new act.
New Act.
Yes, yes. We have savings provision for that. If the court has interpreted something in a certain way, we can take it in the new act as well. Like how we do it for 2013 Companies Act, we have all the judgments from 1956 Act. We apply the same judgments for the new act as well. Similarly, we can do it here.
See, you said if it is interest-free loan, section 48(2) is applicable. Which one? Which section you told?
48.
40, 44.
48 would be a disallowed section. Yet there is no interest allowed.
This one is not. Because you are not claiming any expense over it. But if you are paying more interest, then maybe the excess will be disallowed.
No, the 44 section is concerned with business income. So between the HUF and family, they are giving a loan. They don't fall under that section 44, no, because they are not coming into business.
No, but what if HF is in the business?
No, HUF is not doing business. The income from other sources. It's not a business. So going into the section of that business income itself is questionable, no?
Will not be. Yeah.
Because it's income from business.
Unless HUF is into the business and that funds have been utilized in that business, then even that section will not be.
Like Deepak sir said, it's a disallowance section. So if you have claimed any expense and if that expense is in excess of reasonable limits, then maybe
Then
AO
only
will.
the disallowance.
Again, there assessee there is no option for disallowing. Only if the AO is of the opinion that it is in excess, the AO can disallow.
That too, he should add it to the business income.
Business
Then
income.
only AO can
Correct.
get into that.
Correct.
Otherwise, you cannot. start
Otherwise,
it.
there is no jurisdiction. Correct.
Correct.
Because you see, what all discusses the income from other source. It has nothing to do with the head of income itself. They cannot change.
Thank you everyone for patient listening. As I mentioned in the earlier sessions as well, coming and taking sessions in ICA Bangalore is not a workshop or something. I will always have a lot of things to learn. Whenever I come here, this is I think the third or fourth time I am giving a session. Whenever I come here, I will have a lot of things to learn, a lot of things to take home. So I thank Bangalore branch for giving this opportunity always. And thanks to all the audience for patient listening. I'll now hand it over to you. Thank you.
Before we formally conclude this session, I have an announcement to make. We have 4 full-day seminars on Saturdays, that is 15th November, 22nd November, 29th November and 6th December at APS College Auditorium, NR Colony, Basavadi. 6 hours CP each on New Income Tax Act 2025. Kindly register and take advantage of hearing all the experts in Income Tax Act 2025. The comprehensive seminar on New Income Tax Act happening for the first time. And one more, today GCC Summit is on 12th and 13th December 2025 at National Auditorium. Kindly register and attend. Thank you sir for the wonderful session. I request our Chairman Manjunath Saimundar to present the memento to the speaker. We'll break for high tea and we'll raise some at 6:35. Thank you. Welcome back members. For this 4-day seminar, the fee is only 4,000 rupees but each day is 1,250. But if you register for all the 4 days, it's 4,000 rupees. I request our Chairman Manjunath to escort the next speaker, Siddesh, to the dais and President Karthik. It's my privilege to introduce the speaker. C.A. Siddesh is a regular speaker at our institute. He is a chartered accountant practicing in Bangalore since 2018, having qualified in 2014. His core area of expertise lies in direct taxes with a strong focus on tax application, transfer pricing, and international taxation. Over the years, he has represented clients before various tax authorities and appellate forums. Before starting his independent practice, he has gained diverse experience working with reputed firms including BMR and Associates LLP, KK Chaitanya Law Chambers, Hay Quotation Company, and he was previously partner at NCS and Company, Bangalore. He has played several key roles in professional bodies like in KCA, Federation of Karthik Chamber of Commerce and Industry, SARC of ICA, corporate member of Research Committee and Exposure Tax Committee, Active contributor to the profession, has authored and co-authored articles on transfer pricing and direct tax issues. Then he is a regular speaker at visiting faculty as ICAI, ICSI and GC Law Academy. He has delivered over 250 sessions addressing more than 25,000 CS students and 2,500 charter accounts on topics including black money provisions, demonetization and appellate representations. Before his professional commitments, he is a budding lawyer at stock market enthusiast for over 18 years, and he has held leadership positions with Bangalore CA Stores Master Club, including serving as its president. With this brief introduction, and please CA Siddesh Nagashri. Over to you, sir.
Very warm good evening to all the members. There is this saying called as speakers are the biggest beneficiary of any deliberation for that matter. So ever since demonetization, or rather from 2020 onwards, I have had this privilege from Bangalore branch to deliberate upon section 68 to 69D at least once in a year. So this is the 5th year and this is my 5th presentation on almost a similar topic. If you refer to the old Income Tax Act 1961, hardly about 6 sections, section 68 to 69D, coupled with 115 BBE, hardly about 2-3 pages in a Income Tax Act which was running into close to about 1500 pages. Only about 2 pages is what it occupies. Despite that, members would agree that it is one of the most favorite or most triggered sections when it comes to assessments, appeals and whatnot. I would also say that it is one of the most draconian sections. I cannot think of any other section which is having a highest income tax rate. 60% is the tax rate, as we all know. Plus surcharge of 25%, plus cess of 4%. What more is required? A small penalty of 10%? And if that is not enough, at least once in 3 scrutiny cases, I find it to be around these sections. So this is how it is. Most contentious, most litigated. I can keep on using adjectives on this particular sections. Anyway, I've been blessed with this. I thank the Bangalore branch, Chairman Sir, Manjunath, hello sir. We have Secretary Sir and Jain Sir as well. Members would also agree that the moment 1961 Act was introduced, it's been close to about 6 decades. These provisions, section 68 to 69, were introduced into Income Tax Act 1961 in 1975 or 76. Despite close to about 5 decades of existence, it has not been successful in containing the menace of black money, so to say. The increase of 30% to 60%, which has been done in 2016 pursuant to demonetization, even that is not able to contain this particular menace of black money, in my humble opinion. And now the moment Income Tax Act of 2025 was introduced, the simple thing which I did is to log in into the portal and went to this particular section to see whether this Income Tax Act has made substantial changes to the provisions dealing with black money, section 68 to 69D. And I stumbled upon section 102, pretty much the same replica of what it was there in the old Act, 1961 Act. And as I went about doing this, we joined multiple study circles, we have a lot of small study groups. What we are reduced to, after spending close to about 10 years post-qualification, 14 years in this profession, what I feel I am reduced to is the exercise which I used to do during my childhood days. I'm sure many people will be able to make this image. Newspaper small clipping used to be there, wherein we have to compare between 2 images and spot the difference. And today when I was preparing for the presentation, yesterday when I was preparing for the presentation, day before yesterday when I was reading 1961 Act versus 2025 Act, this is what we are reduced to. Members, what were the claims made? Let us all look at a press release. press release had 4 professed objectives for this 2025 Act. The first one being simplification of language. With that lens in mind, we will look at all the sections down the line. Simplification of language, it seems. The second professed object was a reduction of litigation. This being the most litigated section, I had a lot of hopes as to what is that they're going to do with these sections. Let us again, with that lens, we will look at it. The third professed object was to reduce the compliance burden. These sections per se does not contain any direct compliance like filing return, filing previous returns or paying taxes. But effectively, when they ask you to prove nature and source, I'm sure all members would agree that there is a lot of compliance burden cast upon the assessee. Compliance in the sense, you have to collect a lot of documents, even during scrutiny, you got to submit a lot of documents. So indirectly compliance burden is there. Whether it has been addressed, again we will look at it. The last one is identification of redundant or obsolete rules and forms. Because they say rules and forms, I will exclude the last objectives, but at least the first 3 objectives we will critically look at it, members. And more importantly, after this press release, I'm pretty sure Finance Minister on multiple occasions has promised that this act is more to do with simplification, ease of doing whatnot. They also promised that there will not be any policy changes. There will not be any new levy. So whether this promise has been kept is something which we will again look at it in greater detail. Because if you ask me, members, if I have to only do this exercise of comparing old versus new, I can do this presentation in 5 minutes. One word, shall, was there previously. Now it has been, may was there previously, it has been replaced with the shall. The discretion that was given to assessing officers has been removed when it comes to section 68, 69, all those series. And one more, some change in the definition or introduction of new definition called as asset has been. This is all. I'm done with my presentation. I have achieved the objects which is given by the CA Institute. But my effort in next almost 1.5 hours, my effort with the next 200 slides, I have 200 slides on the, will be to see if whatever judicial precedents have been set in the past will have any relevance given this new act. To see if there is any unsettling of the previous issues. So that is where I will focus my efforts, and pardon me for the speed, members, because time is always a scarce resource, at least when it comes to section 68 and 69, at least when it comes to my presence in any forum for that matter. Thanks to very nice publication by the ICI. This is the extract. Members would notice the last column has sections as it were in the 1961. The first column is dealing with sections as it is in the new act. Section 102 is a replica of section 68. You may be able to notice. There is one effort to reduce the number of sections. That was the focus of the government, I suppose, to reduce the size of the book as if it was a burden for us. Section 69B dealt with 2 instances, investments and valuable assets, group of assets. If it is recorded in books of accounts and if assessing officer is able to prove, if he is able to discharge the onus that what is invested is more than what is recorded in the books of accounts, so addition could have been made under section 69B. Now it has been merged respectively with, if it is investment, if it is merged with section 69, now section 103, and if it is unexplained asset, this is the new definition which I was referring to. If it is unexplained asset, it is merged with section 69 capital A. This is by and large a rearrangement of sections, is what I feel. And one more section has been introduced, section 107, a new section which has been introduced. So my curiosity was what it is, charge of income tax, charge of tax. All this while I thought section 5 of erstwhile act, section 6 of erstwhile act dealt with the charge in greater detail. There is one more charge which has been inserted. The heading did take me aback, but this is what it is. This is section 107 which is newly introduced. It says income referred to in section 102, 103, that is 68 to 69D, shall be charged to tax as per provisions of section 195. So there is guidance, there is this route map given from these sections to 195. You may wonder as to what is 195. 195 is exact replica of 115 BBE. Not even a single word has been changed here and there, but for rearrangement of sections. So what is the purpose of this section? Is it adding to simplification? Maybe. Simplification to whom? Maybe a taxpayer who is burdened with these sections, who is troubled with these sections. Maybe if he is attempting to read Income Tax Act, he would easily navigate. Previously, Section 11 and Section 115 TD, things were scattered. At least when it comes to Section 68, 69 series, we knew by and large, if it is invoked, then naturally consequences will follow, that is 115 BB. Thinking that CAs may be lost in reading the sections, they have given the directions. Hardly anything of significance, but let us look at Section 195. Members, 195, as I mentioned, it is the exact replica of 115 BBE. A quick glance as to what this section is all about. Subsection 1 is dealing with the rate of taxation. Subsection 1 has two clauses, clause A, clause B. Clause A is dealing with a situation where 263 here is 139 return filing. So where an assessee, what a joke on assessee it is, where an assessee on suo motu basis in the return of income which is going to file under section 139, now 263, offers income under these sections. Which sections? Equivalent of 68 to 60. It has been 115 BBE has been recast in 2016, December, President assent. Till date, I have not seen a single assessee opting this particular section. Anybody in this audience who have come across assessees voluntarily disclosing income under these sections. Anyway, it is there in Act, again academic in nature. Clause B is dealing with a situation where assessing officer finds it and brings it to tax. Surplus Roman number 1 of the opinion that it will be taxed at 60%, other incomes taxed at regular rate. Subsection 2 is placing a bar. Again, what is notwithstanding in the previous act has become irrespective. We all know that greater deliberation will be there on Saturdays, I suppose, as rightly announced by the previous speaker, Jain sir. A bar has been placed on three things. One is expenses, second one is allowances, third one is set off of losses. If any addition is made under 102 to 106, bar has been placed. This is the arrangement of the section. Similar to the arrangement which was there previously, what is in green is new act, what is in blue is old act. Pretty much the same members, there is nothing much to deliberate here. What amazes me is, as I mentioned, no assessee has opted a scheme to pay taxes by way of a return of income voluntarily. But let us look at the incentive. What is that he stands to benefit? One is no doubt interest, 234 B and C. And more importantly, there is something called as penalty under 271 AAC. Equivalent of it is also there in the new act. Penalty of 10% of the tax being 60%, penalty is 6% of the total income. To save 6%, can you visualize a situation where assessee voluntarily offers 78%? Where is simplification of language, where is reduction of compliance, where is the focus that we had on these sections? Continues to be there. The whatever burden which was cast upon the assessee continues to be there with just a rearrangement of sections numbers. And one quote which is there on the slide is over to tax involves over to destroy. Can't agree more. Any assessees who have been blessed with these sections, they spend sleepless nights. It's okay if it is invoked in a genuine case, but what about cases where innocent assessees invested in a property by borrowing a loan? Loan is visible in the same deed, loan is visible in the bank account statement. Just because assessee has not responded, section 144, they invoke and pass an order bringing to tax entire purchase consideration under section 69 capital A. Assessee having invested, for example, 70 lakhs in a property will be blessed with a demand of more than 70 lakhs, including interest. Draconian provisions continues to be there. As we all know, it can be invoked only when section 68, 69, all those things are quite evident. It was so felt that 35%, which was the tax pre-amendment, was not penal enough. That's why amendment was brought into play. The question may arise is, what about Black Money Act and the interplay with section 115 BBE and now section 195? Black Money Act is bigger devil than 115 BBE. The tax rates there, we all know, flat 30%, penalty is 3 times the tax is 90%. Only tax and penalty is 120%, forget interest and all other implications, prosecution or not. So there is a respite, because tax rates there are high, respite is provided here. No 115 BB can be invoked, which is quite evident from section 4 subsection 3 of the Black Money Act, Foreign Black Money Act. You all know retrospective amendment was given to this, but the question is, can an addition, can an assessee on suo motu basis offer income under section 68 to 69D or the new set of sections? Section 115 BBE alone has been amended. There is no corresponding amendment in these sections. You all may recall the wordings which are there in the section. It says satisfaction of the assessing officer. Where is the satisfaction of the assessing officer when assessing suo motu basis offering income? 14A also dealt with satisfaction of assessing officer, but 14A also had a provision for suo motu disallowance, which is not there. But anyway, who will challenge this? Nobody will challenge this, because nobody is, first of all, opting for this regime of voluntary disclosure. The constitutional validity of 115 BB was challenged, it has been upheld. A lot of apprehensions were raised before the assessing officer, saying that High Court dismissed, saying that it's all fanciful theories. There are appropriate legal remedies. Anybody who is troubled can always file an appeal, file a writ, what not, under the provisions of income tax. Again, I will not deliberate in greater detail. One of the cardinal principles we had, because there is a change from previous year to tax year concept, assessment year to tax year concept. The cardinal principle was law as it exists on first day of assessment year will be applicable to the previous year. With what background I am referring to this is because the amendment to section 115 BB was made on 15th December 2016, mid-year. After demonetization, after depositing the cash in the bank account, we were told that it is now 60. But established principles are already there. Good number of Supreme Court case laws are put on the slide. The prominent one being Vatika Township. Members would recall the recent one. I think it was a 3-member bench, 5-member bench, 9-member bench. Very prominent one. Vatika Township was of the opinion that any new levy will be deemed to be prospective unless held otherwise, unless stated otherwise, unless stated in the provisions. This was the background. With this background, there are good number of rulings. If you are dealing with any case laws pertaining to years prior to 17-18, including 17-18, you can take support of these case laws. But be also aware, as recent as I have quoted rulings dated to 2021, 22, or not, the recent one being 2025. Assessee who has deposited during demonetization at least prior to 15th December 2016, this is a respite. 30% would be applicable, not 60%. This is what has been held recently. But there are also equally authoritative ruling of Kerala High Court. Very nice interpretation which is being highlighted in red on the slide. The Kerala High Court has rendered a finding that it is not a new levy. It is mere change in tax rate from 30% to 60%. Ultimately, the conclusion is it is retrospective in nature. At least for assessment year 17-18, this would be applicable. So this, all these interpretations have been unsettled in the new act. There is no amendment to even refer to these rulings, but down the line, if there is any amendment, the cardinal principle which we had remembered all this while, that law as it exists on first day of assessment year would be applicable to the previous year, may not be required is my take on this. But anyway, anybody who is still dealing with old issues, I think section 536 of the new act gives life to the cases which are initiated in the old act. Deepak sir would agree. It is some sort of a transition provision. Maybe a session is dedicated in the institute to deal with 536. So I had plans to carry both the new act as well as the old act. This is how we are going to deal with income tax for next at least 10 to 15 years. Because old act continues to exist for the cases that have been initiated so far, the returns that are going to be filed until this year. So old act would continue to apply, this case laws will continue to hold good. So pretty much this is my take on 115BB. Any questions so far, feel free. I have one more hour and maybe I think 175 more slides.
Sir,
Please.
if the SSC does not file the return on which TDS was deducted, so will this be undisclosed income for him? He's not filed, but then he files it after 148.
Yeah.
And then they have slapped a notice of this undisclosed income on them.
Yes.
TDS is deducted, then they have charged 200% penalty on the tax. So is this like, can we justify this?
The question is more in the view of penalty under section 270A, subsection 9. That can be a different topic altogether, but it cannot be undisclosed income because the nature and source would be evident.
Exactly, but they are treating as undisclosed income and thereby charging 200% penalty.
They may casually use the word called as undisclosed income, but I don't think so they would have invoked the section 68, 69 or 115BBE in that. Yeah.
But they have mentioned undisclosed income in the letter.
Very casual reference, it's a passing reference.
And then, so thus they have charged 200% penalty on which income, on which TDS is already deducted.
I can feel the pain of penalty, but I don't think so they would have invoked the section 68 to 690. If it is so easily, you can easily take it down by referring to form 26A for identity and source. Nature being whatever section under which it is deducted, 194J, that's the nature, professional income. So separate sections are there for that, section 28. So it would still be taxable, penalty would still be leviable. Whether there was misrepresentation, separation, 270A, those clauses needs to be analyzed and you can accordingly address. Before even venturing into the section, I would like to refer to this ruling of 1980. This ruling refers to the legislative background. 1975 or 76 is when these sections were introduced into the Income Tax Act. Next year it will be 5th decade of the existence of these sections. Anybody who is taking shelter of hyper-technical legal grounds, not addressing merits, should be careful of these particular interpretations being given by the courts. Delhi High Court was of the opinion that even before the section was introduced, it was already there in place. These things could have still been taxed. This is the findings with respect to section 69C. Look at the findings with respect to 69D. The last sentence, the principle behind this section is equally valid where expenditure incurred by the SSC is not for the purpose of acquiring bullion, all those things, but for some other purposes. Any expenditure incurred not being able to explain the nature and source, it can still be taxed even without these sections formally being there in place. Same is the finding with respect to section 68. These sections were introduced into the taxing enactments step by step in order to plug loopholes and in order to place certain situations beyond doubt. So they ultimately held that it is clarificatory in nature. So I don't require this existence of these sections in the Income Tax Act to be able to invoke. It can still be invoked, held as clarificatory in nature. This was rendered in 1980 members. And similarly worded ruling I have come across in the recent past, very scratching remarks passed on the legal representative. I do not know what went on in the courtroom, but it is worth referring to, members. It is worth referring to. What has been highlighted on the slide is, I'll attempt to read. It says, it is pertinent to mention here that learned counsel of the assessee flooded the bench with legal arguments, as if legal arguments are not good enough. And various judicial precedents of coordinate benches. Okay, coordinate benches, maybe Jaipur ITT is not bound by Bangalore ITT's ruling. I go down to that particular view. They are also not willing to follow the Honorable High Court's findings and Honorable Supreme Court's finding. They are dismissing all that by stating as without addressing the specific queries of the bench. So if I have an addition under section 69 and if I take a legal ground stating that I have not maintained books of accounts, no matter what, you cannot make an addition under section 68. If I am taking that ground without addressing the merits of the case, this is the fate we may end up with. And if that is not enough, a lot of such comments were made. I didn't want to put it all on the slide. And bench of the opinion in the second part of the slide, despite several reminders by the bench, the Governor Council ignored the demand that balance sheet and bank statements of the parties are required to analyze the element of creditworthiness. So is this the law of land? If I submit a balance sheet and bank statements of the parties, will I be absolved of this requirement to prove creditworthiness? Intentionally, bank statements of the assessee was submitted along with its return, which was not required at all and asked by the bench. So they have refused to venture into the legal grounds. So it is necessary, members, we have to address the case on merits as well as on the legal grounds. This has been my learning. With this learning in mind, let us venture into the section. What is on top, what is in green is old act, what is in blue is new act. Pretty much the same. Paucity of time, I will not read the whole thing, but pretty much the same. What has been highlighted is the only change. I think KCA made a representation on this particular topic before the select committee, which was no doubt a confidential representation, but I heard so that Bangalore has made a representation stating that why a discretion which was provided to the assessing officer has been removed in the new act. Where was the promise on no policy changes? Where was the promise of no new levy? And where is simplification here, members? Where is not even a word of simplification I can find? Prove me wrong. I am happy to be corrected on this. Where is reduction of litigation? One of the most litigated sections, and there is no attempt made to reduce litigation. There is sincere attempt to make it even more worse by removing the discretion which is provided to the assessing officer, by making it a shall from may. So as we all know, a quick summary of section 68, anything which is found credited in the books of accounts, it can be anything. If assessee is not able to explain the nature and source, at least nature and source could have been simplified as to what is nature, what needs to be explained when it comes to nature, what needs to be explained when it comes to source could have been simplified. But we have judicial precedents which will refer. If in the opinion of an assessing officer, a tax rate of 78% is left to the mercy of assessing officer, it may be charged, it's a deeming fiction, we all know that. So pretty much the same. A proviso was there in section 68 which dealt with additional obligations. If it is a loan, borrowing or any such amount, which is there in the old act, if it is a case of loan, borrowing or any such amount, additional onus is cast upon the assessee, not just to explain nature and source, which was all the more difficult to explain nature and source. Now I have to explain the nature and source of the person in whose credit, in whose name the credit has been recorded in the books of accounts. So pretty much the inference here is we have to do the assessment of the person who has lent me the money.
Source to
And who, sorry?
Source to source.
Source of source. Exactly the same thing is there in the new act. I will not waste time by reading it out. Source of source requirement is there. If there is nothing which has been highlighted in bold, if there is nothing which has been highlighted in red font, presumption is it is the same. The second proviso to the old act required again additional obligations on privately held companies for investments raised from a resident, be it share application money, share capital, share premium or any such amount. By whatever name called, look at the wide amplitude which is given, by whatever name called. Again, prove source of source. Same thing is there in the new act, members. Nothing much to deliberate. This is the only respite which is there in section 68 for venture capital funds which are registered. Same thing also there in the new act. Again, with the lens of simplification, if I were to rate any simplification being done to this section, absolute 0. Any reduction of litigation, 0. I would not repeat this remark of simplification. It holds good till the last possible slide of my presentation. Old issues hasn't been unsettled. Previously, section 68 had a heading, section heading called as cash credits. Now section 68 or 1 or 2 has a heading, unexplained credits. To that extent, they have simplified. we were of the opinion that if it is cash credit or not received cash, it's loan, how can you bring it to tax under section 68? There were litigations around it, but it was so held that section heading cannot dictate the terms of the preamble of the section. The preamble of old section clearly mentioned any sum, be it loan, be it revenue receipt, be it capital receipt, will be subject matter of taxation purpose. It can be in the name of Siddesh in my own books. For example, proprietary capital, it can be the name of Deepak Chopra sir in my books as loan. In any name for that matter. Well, one respite, again, one silver lining from a quote which was rendered in 1990 is that for this sum to be brought to tax under section 68, it should be capable of being treated as his capital or income. A nice example was given. I was thinking of a situation where credit in my books of accounts cannot be in the form of a capital or a loan or an income. In the example which was rather the case, the facts of the case involved a situation where I had lent money to somebody 10 years back and he has returned it to me. When I'm repaid my own money which I lent 10 years back, should I be burdened with the responsibility of proving nature, source, as to how the other person has got? The first thing I would be interested as a businessman is to get it back to the first instance. 10 years he has held on to my money. So in such situations, the court is of the opinion that it cannot be subject matter of section 68. Can we stretch this beyond the facts of the case? Answer, in my humble opinion, is yes. A lot of cooperative societies where members were initially lent money and they have returned the money, I have deposited in my BDCC bank, respective DCC bank. Should it be subject matter of section 68 focus? My answer is I would happily rely on this. It is my own money which is being returned. So source is explained. Nature is explained. Very interesting findings from Allahabad Indoor ITA. Again, mere credit entry representing a liability. Example could be a trade payable. In the case of trade payable, no doubt it is also a credit entry, purchase, creditors. Should I explain nature and source? I have made a purchase from a vendor, from a creditor. Should I be explaining the source as to how he is capable enough to sell me goods? Answer is no. Anytime you are blessed with a notice where section 142(1) requires you to explain nature and source of creditors, please do cite these rulings which are there on the slide. Bogus transactions, again, you don't have to explain the nature and source. Found credited is of significant importance, members. The purpose of this section is to bring to tax something which has gone untaxed. Madam was referring to a question where something which has not gone untaxed, which has gone untaxed, should be brought out in this section, but it has got, as I said, wide amplitude. It can also tax sums which are capital in nature. Instances where something which is liable to be disclosed under section 28, section 11, for example, the last part of the slide deals with the corpus donation and donations. Can an assessing officer question the nature and source? We have separate section, like 115 BBE. For donations, we have something else, anonymous donation. There, the requirement of the law is quite simple. Just give name and PAN, am I right? For donations, sorry? Identity, name and PAN would suffice. So when 115 BBC is applicable, there is no need to venture into section 68. So in the context of charitable organizations, this is the finding. In the context of business organizations, there is one nice Supreme Court ruling which I have referred. A presumption is made. If an assessee is engaged in business and if there is anything which has gone untaxed, the presumption is it is arising from the course of business itself. Don't have to challenge the nature. Lakshmi Chand Baijanath, Supreme Court ruling. A lot of instances where in the case of a survey, assessee is found with excess stock, assessee is found with cash during the course of search. Should it be brought under section 28 or should it be brought under section 68 and now section 102? The first ruling which I referred is in favor of assessee. The obligation has been cast on the revenue department, saying that since the revenue was unable to show that assessee has any other source from which he could have derived this excess stock, the presumption is it has to be taxed under section 28. The second ruling is far more authoritative, being referred by department in almost all cases on this particular issue is Kim Pharma. There the onus has been shifted to the assessee. It says where amount surrendered during survey was not reflected in books of accounts and no source from where it was derived was declared by the assessee, the presumption is that it is to be taxable under section 69 capital A. But I would be far more inclined towards the second ruling, Punjab and Haryana High Court. The reason being section 68 casts an onus on the assessee to prove the nature and source. There cannot be any presumption. Very nice analysis of this set of sections by old ruling of Gujarat High Court, wherein it is not just 5 heads of income which we are all commonly aware of. Section 14 makes way for altogether different category of income, that is section 68 to 69B. It says section 14 starts with save as otherwise provided in this act. So we have, in my opinion, rather 6 heads of income. Found credited is there in the old act as well as new act. That's the reason I am referring to all these things. Again, case instances where business income is sought to be recharacterized as section 68 income. A lot of case laws in favor of assessee, but there is some obligation. One case law which I have held on to, very authoritative case law, fastest to travel to High Court, demonetization cases, Axon Global, Delhi High Court ruling, tribunal ruling upheld by Delhi High Court. Assessee who is into trading of dry fruits had deposited 160 crores into the bank account. Look at the focus, look at the money that was there at stake. And to be able to discharge that it is my business income, it is something which is undisclosed business income and not undisclosed income under section 68. Assessee had to undergo following tests. One is growth in sales is consistent with previous year. What kind of test is this? It is a punishment to assessees who are flourishing. So last year I made a professional income of 10 lakhs, this year I make a professional income of 20 lakhs. So is 100% growth something to be frowned upon under section 68? But anyway, at least in this case, assessee was able to discharge that growth was consistent. Next one, increased trend in sales is also reflected pre-demonetization. Apparently there was a 1000% growth month on month basis. Dry fruits business. And when pre-demonetization sales were not doubted, only demonetization sales could not have been doubted as the finding. Complete set of books accounts were provided. Stock details in tax audit report. The importance of stock details were provided, and assessing officer was not able to refute anything with respect to stock details. No evidence of bogus sales, no finding, no investigation, nothing. Just invoking section 68 because assessee has deposited 160 crores into the bank account. ITT as well as High Court came down heavily saying that this is not acceptable. Look at the finding members, I will only read the first line here. Tally software runs on ODBC. Rarely one finds an audit trail. This was rendered, this ruling was rendered in 2020 I suppose. Then the last sentence. The time has come to also look into the usability of such accounting software by the regulator. And we all know what it led to. Judicial activism. Or planning activism by assessees. One more interesting ruling which is also there in the context of, it is not just to be restricted to demonetization, that would be very limited and narrow thinking. It is also applicable to any case where you have business income which is sought to be recharacterized by assessing officer as undisclosed income under section 68. Multiple surveys were conducted on the assessee to find out truth. Assessing officer did not bring about anything. Very high sales were made by the jeweler on the eve of demonetization. 5 crore is the reported turnover on the eve of demonetization. Otherwise, his average sales was just about 1.5 crores. Daily average sales was just about 20 lakhs. Average sales during Akshaya Tritiya Dhanteras was 1.5. despite assessee clocking 5 crore turnover, a newspaper clipping was referred by ITAT. The newspaper clipping made reference to the mad rush which was there at Jeweller's place during demonetization. So, theory of human probability possible, especially when assessing officer has not refuted books of accounts. Same income cannot be taxed under section 28 as well as section 68 was the opinion, and ultimately it was held in favor of assessee. Again, next important phrase which was there in the old act also continues to be there in the new act is books of accounts of an assessee. A sum of credit has to be found in the books of accounts of the assessee. Very wild interpretations, members. We have a definition of books of accounts, again defined in a very wide manner. What is highlighted in red is books of accounts, no doubt includes ledgers, day book, cash book, and other books. Whether and other books includes loose slips, diary notings, any rough scribbling of the assessee is something to be deliberated. The second part is, which is in bold, also underlined, is with respect to the ruling of Chennai ITAT, which had referred to the instance where entries were deleted from CPU, whether can it be subject matter of, can it be called as the books of accounts and can it be subject matter of addition under section 68. Chennai ITAT had given a favorable finding to upset that particular thing. They have brought about this amendment. So even in electronic form, digital form, printouts, data stored, can still be considered as books of accounts. With respect to the red font, whether other books would include diary, we have good number of precedents. What is books of accounts is something which is very formal in nature. We will also refer to High Court rulings down the line. So existence of books of accounts is a precondition to invoke section 68. No brainer, there are good number of rulings there. Anybody who is trying to misuse this particular ruling, the second part of my slide is dealing with that. Assessee had maintained books of accounts but had not produced it. Now we cannot take a shelter under section 68 of this argument saying that books of accounts are not maintained and are not produced. Addition was still upheld in those cases. And last case is dealing with a situation where he was required to maintain books of accounts, not maintained. So section 68 says entries found credited in books of accounts. So there is a situation here where assessee has not maintained at all, yet addition was upheld. So too much reliance on the legal grounds may not help assessees. So this is a case, members, where based on bank account entries, bank account we all know is a bank statement, is a account maintained by the banker, my account with the banker. It is not books of accounts of the assessee maintained by the assessee. It is maintained by the banker. Yet addition was upheld. So basically, every legal ground you take has a adverse ruling. Got to be little careful in representing the assessees. The most authoritative ruling, members, Sunil Kumar Sharma, where it has been held, Karnataka High Court, recent past, 2024, where it has been held that loose sheets, diaries are not to be considered as books of accounts. The landmark ruling on this particular matter is from Bombay High Court as to what is books of accounts, what purpose it has to serve. But because the requirement of books of accounts have been diluted by adverse ruling which I referred, so both in the new act as well as old act, whether or not you maintain books of accounts, addition can still be made under section 1 or 2 of the new act. What about instances where I have maintained books of accounts, assessing officer, just to make random additions, has rejected my books of accounts, invoking section 145 subsection 3 or whatever it may be, has found the discrepancies in my books of accounts. In such situation, can he still refer to other credit entries and make addition under section 68? What could be your answer, members? Having rejected books of accounts, how can he catch hold of the same thing and again refer to some credit entries and make addition under section 68? This is the finding, a favorable finding from the court. Example that was cited is on a trade payable, addition cannot be made. But again, be cautious. Look at the finding here from Punjab and Haryana High Court. Addition on account of cash credits, even if the net profit rate is applicable, could be made, but it depends on facts of each case. So even in instances where books of accounts are rejected, assessing officer can still grab hold of the same, analyze the credit entries, still make an addition. If you are able to prove that the net profit percentage which is applied by rejecting books takes care of this particular thing, then you are saved from addition. But the passbook is a book, as I mentioned previously, very authoritative ruling. It was rendered in 1983. Till date we were making use of it. Then came a ruling which by mistake I have not brought it on the slide. I think it was there in the previous slides. Though passbook is a book of account of the assessee maintained by the banker, it is still books of accounts, because Act is very clear. It says books of accounts of the assessee. Act does not prescribe a condition that books of accounts as maintained by the assessee. It only says books of accounts of the assessee. But play with the language. Any effort made, remember, any effort made on simplification here, reduction of litigation, no. We still don't know books of accounts means it can be anything. The wild interpretations which we referred in last 5-6 slides, books of accounts, maintain it or not, addition can be made. Whether you maintain or not, addition can be made. Whether your account reflected in somebody else's account, banker, addition can be made. So what is the purpose of having a word like books of accounts of the assessee? Previous year debate, any sum found credited in previous year, for example, I record a credit entry in the year 2025. Assessing officer notices that credit entry as opening balance in the year 2030. While doing scrutiny for the year tax year 2030-31, can he make an addition on account of credit which first appeared in 2025? They say in the year in which you credited, in that year, it has to be added under section 68. The same interpretation also holds good even in the context of the new act. Similar usage of words, if not previous year, that tax year has been used in the new act, members. Very authoritative ruling on this case is first one. Yuan saying any opening balances, automatically you can escape the clutches of requirement of section 68 by just citing one ruling. Yuan saying very authoritative. Till date, nobody has dared. It is 2022 ruling. We also have other rulings, 1975, 1983. Till date, I have not found even a single ruling against assessee, and this interpretation holds good not just for section 68 but also for all other sections, section 69, 102, 103 types. Having made an addition under section 68 initially, during the course of assessment, if I take an opinion, if I take a contention that section 68 is not applicable because assessee has not maintained books of accounts, can CIT at the stage of appellate proceedings shift the addition from section 68 to section 69? Can an ITT do that? I've listed good number of case laws which are in favor of assessee, but far more authoritative rulings are there. It is not just discharging the obligations under section 68, you have to discharge obligations under all other sections, because they can just immediately change the sections. We have section 292B. If not 292B, we have support of other rulings, because what is the obligation cast on the assessee when it comes to section 68? Discharge, nature and source. What is it under section 69? Nature and source. 69A, B, it's all nature and source. What is the prejudice caused to the assessee by shifting sections if you are failing to discharge nature and source? Nature and source can be the best possible deliberation of today's meeting. Just ventured into that. Simplification again, members. Act is very clear. Old act, new act. It says explain nature and source. As I mentioned, be it section 102, 103, 69, 69 capital A, any sections which are given to me refers to this phrase called as nature and source, except the section 69C dealing with unexplained expenditure, because they know that you have expended on this particular bottle, so nature is evident. Under section 69C, what is required is only the source. So by and large, this phrase is there everywhere. Section 1975 till 2025 has only these two words, nature and source. But the interpretations, as far as 1963, even before these sections came into play, interpretation as far as 1977. Supreme Court is of the opinion that what nature and source meant actually is identity, creditworthiness, and genuineness of the transaction. Why not plant these words in the act? Why mislead assessees? Ask nature and source, then ask them to prove identity, creditworthiness, and genuineness. What is identity? Very rarely I have come across instances where I am not able to discharge identity. In my opinion, how can an assessee discharge identity? Couple of things on the slide, PAN and birth. I was thinking of a situation when an identity can be questioned. Is that in a situation where a company's name is striped off, then identity can be questioned. Otherwise, by and large, I don't see any problem in identity related debate. Creditworthiness is a big task to be addressed. How do you prove that the person who has lent you money is worthy enough to lend me this money? Now that you are required to prove nature and source of the assessee and also nature and source of the person who is lending you the money, so there are double obligations. You have to prove creditworthiness of the lender. The lender has to prove creditworthiness as to how he's got the money. So with that burden in mind, let us address this. There are instances where if I have received a loan, I would make a submission that this money is received from this and this person through banking channels. Whether the banking trail would be sufficient to discharge creditworthiness, the answer is no. Authoritative ruling of Supreme Court. Whether provision of financial statements, as it was held in Jaipur ITT ruling, which was referred in the initial part of my submission, bench member asked for financial statements and bank statements of the creditor. Would that be sufficient for me to prove nature and source of the creditworthiness of the lender? May not be. ITR, I present an ITR. I have lent money after earning for 10 years. I have lent money. I am now into money lending business. This year ITR would report a nominal income. Previous years I have earned. There are multiple other sources through which I can lend money. Assessing officers refer to ITR and they say you have offered only 10 lakhs while you have lent 20 lakhs. Creditworthiness is disproved. Favorable ruling is there, members, on the slide. The income disclosed by the creditor would not be a barometer to gauge the creditworthiness. Then what? Financial statements is not a creditworthiness, bank statement is not, ITR is not, then what? Few more things on the slide. Statement of assets and liabilities. If you are not maintaining books of accounts, consider source of receipt of funds as to how a person has received funds. You provide a nature and source, you provide identity of the creditor and then request assessing officer under section 133(6). Ask assessing officers, this is the PAN number of the person, you please ask him. This is the submissions we used to make prior to the amendment by Finance Act 2023. Now pursuant to the amendment, obligation is placed on me. I cannot simply say that you make further investigation because Act is very clear. I have to discharge the burden. So when I now borrow loan from Deepak sir, I should also ask for income tax logging credentials. 1 year ITR is not sufficient. Logging credentials and last 10 years balance sheet.
So that means this creditworthiness is something which will be kind of impossible to prove because if the other person is not willing to support. So one part is that my effort, okay, I am willing to go all the way around. But if the person who has given to me, because that's where there are a lot of lenders or the vendors, they do not want to provide all the details because there are 15,000 things they do. So that means it is impossible.
On a TDS case I was addressing before coming to this premises. Amazon has rendered some services. Amazon Global has rendered some services to Indian party. We are not done TDS and we want to take precedent of DTAA. One document that is required is TRC. I called a client and said, get the TRC. Anyway, it's Amazon standard care. They said there is no standard customer care. This one. There is no relationship manager. TRC is difficult from Amazon. Imagine getting such a document from assessors. And if I am supposed to discharge the creditworthiness, I am satisfied by giving PAN number and making bank account statement. But I have to satisfy the assessing officer. Not once, twice. My creditworthiness and his creditworthiness.
So in your experience, which are the situations where the officer was eventually happy with the credit worthiness thing which you have presented? So what about any examples where finally eventually it ended?
No, sir. It's all litigated. It's all litigated. You would be happy if I borrow 10 lakh rupees from maybe Mukesh Ambani. Sourceful person. Resourceful person.
But he can still ask you 5 years.
ITR. Yeah. ITR. How can I ask my lender? ITR. Some rulings are there in the slide which I will address down the line. There is a verification unit. Assessment is being done by assessment unit. There is something called as verification unit. You request assessing officer to engage verification unit and make additional inquiries. Source of source is not required in the context of things which are not hit by the provisos. These rulings can be used. And 133.6 and 131 or verification unit can be a double-edged sword. The reason is I can give 10 PAN numbers and ask assessing officer to verify. He will give a notice under section 133.6, giving 2 days time to respond to the creditors. And if they don't respond, then it will backfire me. Assessing officer will mention that you asked for 133.6 to be served. We have served it, they have not responded, then you leave happily with the addition. And some instances where a couple of practical issues were appreciated by the Kerala High Court. More than 15 years have elapsed since the 11 accounting years. And they have acknowledged that it will be difficult for assessing to prove. But High Court coming down with a rescue, Act coming down with a rescue, assessing officer coming down with a solution makes a lot of difference. Going to High Court and getting this relief is not an easy task, members. Lot of representations have been made by KSA. Lot of representations have been made by industry bodies with respect to the draconian nature of the section, nature and source, creditworthiness. No reply of any sort has come from Income Tax Department. They could have done something in the new act, not done. One investor, angel investor, Ashni, he tweets in the public domain which gathers a lot of activity on Twitter. Income Tax Department, not by way of a circular notification or any relaxation, Income Tax Department also replies to the tweet saying that creditworthiness of the investor need not be proved by the company. You don't have to get the ITR or bank account statement of the investor, is the reply of the department. Income Tax Department has given a solution. You just give PAN number. Giving PAN number not only addresses the identity, giving PAN number also addresses the creditworthiness. And now, previously when I prepared submissions, I used to refer to case laws, High Court, Supreme Court, so many case laws on the slide, off the slide, tax PAN, tax uta. Now I refer to this tweet. I do that. What injustice have been committed by other assessees? Why only lip service to one such investor? Because he is an angel investor. Because his tweet has gathered momentum. So it is important not just to be good with Income Tax Act, it is also important for you to have a good follower base on Twitter. Lot of text as to what this source of source is casting a lot of obligations on the assessee. Rightly acknowledged. Which ruling? 2014 NR portfolio private limited. I can read members, but I'm afraid if I'll be able to cover sections. Then there is another thing. Identity was easy, creditworthiness was little difficult. Genuineness is altogether different kind of. What is the genuineness? Why did you borrow from Deepak sir when you already had 1 crore in FD? Genuineness, how do you prove? Science has not yet invented an instrument to test the reliability of the evidence placed before the court. Durga Prasad More, Sumiti Dayal, I'm sure this is a landmark case when it comes to section 68 and 69. This lady was constantly winning lotteries. Never played lottery in her entire life. 1 year she plays lottery, 3 lotteries I suppose, wins all 3 lotteries. Next year she retires from this lottery business. That is when gift tax I think was introduced. Gift tax or a tax on lottery was brought into act pursuant to that. There this a test of human probability has been introduced. Is it humanly probable for an assessee to win all 3 lotteries and then escape from this business? Sumiti Dayal also made a nice remark, say, reject mere paperwork. So if I borrow from genuine sources, it's very difficult to get all the papers done. But there are instances where Kolkata-based companies, the moment they give loan, they also give a set of documents, ITR, bank account statements, whatnots. In such cases, the paperwork has been rejected. Kolkata, I am not generalizing, but a lot of public case laws in the public domain. One sentence I'll read: assessing officer cannot start the assessment with a preconceived notion about the unaccounted investment. Today, when I get 142.1 notice, the very first notice lists out all the credit entries, all the liabilities out of my balance sheet, explain trade payables with name, nature, source, explain secured creditors, explain unsecured creditors, loans, borrowings. The very start of the assessment itself is with a suspicion. It also reminds me of something called as taxpayer charter members. Taxpayer charter says, begin assessment, trust-based assessment. It's all a slogan in my humble opinion, no actual results. To the satisfaction of assessing officer, I will not speak much on this. Satisfaction, a couple of authoritative rulings is satisfaction. Dehorse the material is invalid. Satisfaction has to be based, it has to be objectively done with reference to material. But nowadays you make a submission, detailed submission, assessing officer just casually states not satisfied with the submission. One word, not even a speaking order, one sentence can make an addition under section 69. 68. A lot of other rulings. These slides will be put up on the ICA website for further reference. Whenever a question is asked on section 68, when assessee discharges the initial owners by addressing identity, creditworthiness and genuineness, the onus shifts to the assessing officer. Assessing officer cannot just say no. Assessing officer is an investigator cum adjudicator. Adjudication requires answering yes or no. Investigation requires he has to cause further inquiry. Instances where assessing officer just rejects my submission, I can take this citation of this ruling, wherein it states that there is an obligation cast on the assessing officer. He has to discharge his owners by conducting further inquiry. If I provide a PAN, he has to conduct further inquiry. If the inquiry is shabby, then addition is also on a shaky grounds.
But then you were saying that in some cases they will just say no, simply no. So
Because they are assessing officers.
Yeah. So that means while the law is expecting them to go into detail, but they do not. In many cases, they just say no. So in several cases, when the section 68 notice is received, that means we need to assume that we are for a long term gone for litigations and fighting, unless they are willing to do all the times.
So at least we can caution assessees, be a little careful in undertaking the transactions. Compliance that is required under these sections can be.
So that means the benefit of understanding section 68 is not the litigation part, but the part where the client comes to us for the planning and the etc. That's where we can guide them into correct.
This is the only change which has taken place, old versus new. Previously, despite no explanation being provided by the assessee, or if you provide explanation, even if assessing officer is not satisfied, addition could have been deleted even at such instances. It was a discretionary. He may still have continued without making an addition or accepting a returned income. Now the discretion has been completely taken away. The moment it is a case of lack of explanation or lack of satisfactory explanation, addition will still be made. And the provisos, member, I have already dealt with provisos. Anything on the provisos, anything on section 68, you can let me know. By and large, I have issue-based instances are there. 56 to 7B is not there, angel tax. But the same thing could have been subject matter of section 68 as well as section 56 to 7B. If you raise a share capital from a resident, can I pick and choose a section? Can I say that no, anyway this share capital is abnormal, I want to make an addition on suo motu basis, or conceding before the assessing officer that I am happy with angel tax because 30% tax rate and don't touch section 68. Can I do that before the assessing officer? Answer is no. If you are able to satisfy nature, source, then 56 to 7B can be made. If you are not able to satisfy nature and source, though addition could have been made under angel tax, section 68 can still be made. This is not only to be looked at only in the context of section 56 to 7B, even gift for that matter. I have received a gift from a friend, which no doubt is taxable, more than 50,000 rupees, no doubt is taxable. Can assessing officer in that situation venture into section 68? Answer is yes. On what basis do I say that? The interpretation in the context of section 56 to 7B. So anything which is found credited, be it gift or anything for that matter, can still be subject matter of section 68. Penny stocks, lot of interesting cases. Peak credit argument can still be raised, whether it is old act or new act. What is peak credit? Anything which has been withdrawn earlier is presumed to be available with the assessee for the purposes of redeposits, more in the context of loans and cash deposits. Telescoping, first year they make an addition on account of cash that is found. Cash of 1 crore rupees found, 1 crore rupees addition has been made. Second year, the same cash has been invested in a property. Can they still make one more addition in the second year? Answer is no. First addition telescopes, the second one. Instances where I raised loan on first day of April of the previous year and repay that loan during the year, can it be subject matter of addition under section 68? Answer is yes. There are rulings which are in favor of assessee, but there is no judicial, there is no legislative support in that regard, members. Coming to section 69, exactly the same thing has been recast in section 103, but for the thing that has been highlighted. What has been highlighted is something which was previously there in section 69B. It has just got merged verbatim into section 103. So it is just merger of two sections, otherwise there is no significant changes, members. So if any investment has been made and if you are not able to explain same thing, nature and source, which was previously discussed, addition can still be made, whether it is recorded in books of accounts or not. That's the first leg of section 69. The second leg of section 69 is investment is made, it is also recorded in the books of accounts, but assessing officer brings about a positive evidence to prove that what you have invested is more than what is recorded in books of accounts. Addition can still be made under section 69, now read with section 103. No other changes, no significant changes there. Yes, please. Good number of issues have been highlighted here. Today I have gone past to section 68. Last time when I was given 2 hours, more than 2 hours, I was not able to go past to 68. I improved. But way too many slides. The reason why I put so many things on the slide is it is highly contentious, understand. It is worth referring to because entire income tax is surviving on these sections, I suppose. Looking at the trends in the assessment. Again, 69 capital A, this is old act. The same thing is there in the new act, but for these changes. In the old act, please note the phrases. Assessee is found to be the owner of money, bullion, jewelry or other valuable article. This phrase has been reduced to one word called as asset in the new act, which is there in the first line. This asset has been defined in the subsection 2 of section 104. What is asset? Asset includes money. So it says asset includes, it's an inclusive definition. Money, bullion, jewelry, virtual digital asset, a new inclusion. The promise which was made in the policy is no new levy. VDA has been inserted here. And other valuable article. You may say that anyway other valuable article which was also there in the old act covers everything. Why inclusive definition? Inclusive definition because very wide interpretation given by Supreme Court. In the case of D.N. Singh, this person was tasked with carrying one raw material. his responsibility is to carry 1000 kg here and deliver 1000 kg here. By the time he delivered, the weight was reduced to 900 kg. Section 69 capital A was invoked on that assessee to say that this ore, I think it was bitumen, whatever he was carrying is valuable asset, it has a price. So whatever is the shortfall, 100 into whatever is the price of the commodity in the market was subject matter of taxation there. The Supreme Court held that it is not a valuable asset. Just because it has a price doesn't mean that it is a valuable asset. Was the finding? To upset that finding, inclusive definition has been inserted in the new act. It says includes. So it is not just even the bitumen will be included, even this model will be included. That's a wild interpretation, wild amendment that has been made. And secondly, it was also held in the Supreme Court ruling that assessee is not the owner, he is only tasked with the transportation. Who is the owner? The person who is sending the goods is the owner. Till it is sent, the moment it is sent, this person becomes the owner. Either of the persons will become the owner, not the person who is transporting. In the old act, only the person who is found to be the owner. In the new act, the person who is found to be the owner by or belonging to the assessee. So one ruling of Supreme Court, 2 amendments in section 104.
Auto sweep of FD was also considered as income, both investment and the maturity. Many SSCs got notices on that.
Unfortunately.
All the things were added, like the maturity as well as the investment, and clubbed as income.
And if you are doing that renewal every 3 months,
Yes.
1 crore rupees investment, 4 crore rupees addition.
Exactly.
Tax is 5 crores. Penalty, ma'am, penalty.
And
Technically
you
it's
don't
not
understand,
278.
even if you're giving ledgers and everything, the assessing officer denies to understand. I do not understand the concept that they do not understand debit and credit, that what money is getting invested, that is getting matured. But they do not agree to this. No explanation is accepted by them.
Though I am an income tax professional, ma'am, I eat, leave and sleep Income Tax Act. The only way, I say this with a lot of integrity, the only way to simplify income tax is to abolish it. How can you simplify section 68? No doubt I can happily stand here and criticize. I'm pretty sure creditworthiness. How do you do it?
And then the person is like of the view that they don't want to listen to your explanation. You cannot make them understand what the problem is.
In a very peculiar case, we got a notice as in we facing a scrutiny assessment of 1%. They are asking us the creditworthiness of our creditors, Sunday creditors. They have supplied goods to us and that is what is outstanding in our financials.
So I had a couple of cases in the beginning. Creditworthiness is something which can be capable of being treated as a capital or an income. So in the case of purchases, having accepted purchases, which is subject matter of section 28, you cannot bring it again under section 68. And moreover, it is not a credit entry which is leading to some positive cash inflows. So some rulings were there on the slide. Don't have to explain.
And that's what we replied around the last week only. We replied to that telling that we have the purchase bills and they are the goods which they have purchased from them. To raise the question of any loan, because section 68 clearly speaks about any loans which is being taken from the credit.
Loans is an additional obligation, but it says any sum from credited. So it can be anything and everything on the credit side. So technically speaking, yes, it is applicable, but ruling-based relief can be claimed by assessor. 69B, as I mentioned, members, it has been merged with 2 sections which I just referred. So not much interpretation there. 69C, as it is not even a single word here and there, as it is there in the old act, as it is also there in the new act. So this pretty much concludes my presentation. Unless you got specific questions, I am more than happy. Again, in the last session, 69D is something which 14 years of my experience in direct tax, I never come across one instances of 69D being invoked by assessing officer. Maybe my limited knowledge or exposure in the market, I still fail to understand what is hundi. So this section could have been deleted. Redundant sections which are anybody who is exposed to these sections.
In fact, we have seen what hundi is as such.
Nice.
It's a promissory note which was written, but I don't think so it is written. It is written now, but during my articleship I have seen a Undi.
Super, super.
Yeah.
Sir, I think still only while they are kept, still only are there in temple.
No, I think it's a promissory note.
That Undi is taken care by 115 BBC. Siddesh, in the previous session I had not allocated time for Q&A, which was the feedback which I received. Now I will happily be there in whatever time members are willing to post queries, otherwise I'm pretty much done with my presentation members. Any queries, please? I'm on slide number 192. 8 more slides. 8 more slides, so that I request, indirectly I placed a request before the chairman. Call me once again on the very same set of sections. Hopefully I'll address 8 more slides which are there. Because the trend has been, sir, as I mentioned in the beginning, every year I have presented on these topics, every year in the same forum.
Yes.
And every year the relevance is just the same. Slides are getting bigger. It's not my problem. How many tribunals are there in India, ma'am? I think every other state has got a tribunal.
Yes.
If not Goa and all, it's true. Maybe 20 tribunals. Bangalore has 3 benches. Mumbai has 16 benches. Delhi has 30 benches. Every bench is passing an order on section 68. One is favorable, one is against us. One requires books of accounts, another requires doesn't even require books of accounts. If ITAT rulings are not enough, we have high courts. We have Supreme Court. Even if Supreme Court renders a finding, we have Parliament. Upset the rulings. So academic indulgence will continue to be there, whether it is old act or new act. Same set of sections. I'm assured, I had made this statement in the past also, I'm assured of, I don't have to worry about EI coming into play. No amount of EI can satisfy the requirements of assessing officer. You find one ruling favorable assessee, another ruling against assessee. And I was a little taken aback because new act, whether it is simplified to such an extent that I may lose the practice. And with this kind of sections, next 15 years, I'll refuse to change. I'll refuse to adopt the change of going to AI classes. Not required to venture into GST, black money. 102 to 106 or 105, 5 sections, 5 decades. Like it has taken 5 decades in the past, 1976 to 2026. Another 20. Anyways, members, on a lighter note, I thank once again Bangalore branch for, unless anybody has got questions, for a wonderful opportunity, sir, for my academic indulgence. I cannot be more happier than this. Thank you once again and back to you.
Good evening, esteemed members. I am C.H. Prakash, managing committee member. Deeply honored to deliver this vote of thanks for the highly insightful study circle meeting organized by our branch. On behalf of managing committee members, ICA Bangalore branch, we extend our sincere and heartfelt appreciation to our distinguished speakers, CA Karthik, Shastry and CA Siddesh. Your deep dive into the intricacies of the new act and was an exercise in conceptual clarity and practical application. Now I request our chairman, Nindranath, hello sir, to present a memento to the speaker as to open. Finally, our dining members and professional colleagues, thank you for your active participation and engaging questions. Your presence is a testament to our collective commitment to excellence and upholding the highest ethical standards through our noble profession. Thank you. We'll see you in the next workshop on this Saturday at APS College of Commerce.